far? So what's the best present? I knew. First one, of course, my car. What is the second? iMac or Oculus Rift or Oculus. That's what it's on. You got on the 3 years. So which one is best? This one or this one or this one? Maybe actually Suitcase is like ultra. It might be all of them because it's like really top quality. You can't buy it anywhere else.
Vow to deliver 1 billion extra vaccine doses over the next year. We're live in Cornwall. Asian stocks and European futures climb with treasuries ahead of a crucial US CPI print this afternoon, which could provide clues on monetary policy. And the ECB will plot the next phase of its pandemic bond buying program at today's meeting. We're also live on the ground in Frankfurt. Welcome back to the programme, everybody. The second hour of the European market open. 10 seconds or so to go until the start of the cash equity session. And we've got European equity market futures pointing slightly positive. But as I mentioned at the end of the last hour, Nasdaq futures just turning negative, and we're fairly flat on US futures. So we'll keep that in mind as we get these European equity markets open. We're certainly looking for a bit of upside on some individual names, certainly in London around BT, a stake in that business being taken by Altice over in France and Patrick Drahi and co. So that's certainly an interesting story that we will keep an eye on. More broadly, there are plenty of macro themes to get into when it comes to the US inflation picture. Of course, we'll have the data out later on today, the ECB in focus over in Frankfurt. We will also, of course, keep an eye on what's going on in Cornwall, down on the beach there at the Carbis Bay Hotel, thinking about all of those geopolitical themes, climate change, rollout of vaccines, relations with Russia and China, all of that very in the mix, include also financial things like tax as well. So with that, all of that in mind, we see European equity markets making some modest gains this morning, up by 0.2% on, in fact, most markets. Well, certainly on the Stock 600 as a whole. That applies also to the FTSE 100 and the CAC 40. Gains a little weaker, but gains nonetheless coming through on the DAX. The IBEX in Spain up by 0.5%, and the FTSE MIB in Italy fairly flat right now. So flat to positive, really, for European equity markets. This is coming ahead of the highly anticipated US CPI data due out this afternoon. Bond bulls have taken the US 10-year yield back down below 1.5%. It signals support for the view that the rise in inflation stoked by the pandemic is temporary. It signals that, or it signals that the Fed is going to focus on unemployment instead. Let's talk to Simon Harvey, Senior FX Analyst at Monex Europe, who joins us now. Simon, very good to speak to you. So let's think about some of the data that's going to be coming to us this afternoon. We've got inflation coming through from the United States later. What are you going to be watching? It's going to be a long time before we find out, really, whether inflation is going to be temporary or not, whether this is going to leave us with a sustained higher base level of inflation for the US economy. So what's in the data today?
Oh, exactly as you say, it's going to be some time before the market really understands whether the Fed's messaging is correct or not. You know, the Fed said that it's going to be a temporary overshoot, but how long is a piece of string, and how long does it take for the inflation to begin moderating again? And can the market tolerate this in the short term? And we think that ever since the Fed pushed back around March with regards to inflation, with regards to setting very high threshold to tapering, we always thought that the market had somewhat overstretched, and that's why we called for a decline in the dollar with front-end rates being anchored, and that's what we've roughly seen. And we're starting to see now, I think, really fixed income markets settle in for the long haul. They understand that in the short term, they're still going to see this and this upshoots in inflation. The upshoots in inflation is still going to be pushed back by the Fed, especially for the next quarter or so. The question is now, when we're coming into Q3, Q4, is inflation still going to be there? And are the markets going to be content with the Fed, really just reacting to this by announcing the tapering of QE, which we expect around Q3? When it comes to all of these different dynamics, it's very hard to pick through the CPI data at the moment to get any indication of what's coming, how quickly this is going to moderate and so forth. Markets are looking at month-on-month data prints because it strips out the transitory base effects. But even then, it's very, very difficult with the pandemic-induced disruption in the US economy to understand what is really the underlying inflation level in the economy there, and how long it's going to, how long it's going to take to moderate, and where it's going to moderate back to.
Yeah, and give us a little more on what you think the messaging is from the bond market right now, Simon, and what really cross that has into your world of FX, because we do sit here with once again very low yields on the US 10-year. We came down from 1.7 a little earlier on this year to 1.48 is now the handle, so below 1.5% on the 10-year bond yield. And is that because the market has come round to the view that the Fed has, that this is going to be temporary, or is it that the market just thinks it might or might not be temporary, but the Fed is watching something else? The Fed is watching the jobs market, and that's what's going to matter more to bond markets.
Well, you can look at it multiple different ways, because you can argue that markets are coming around to the idea that inflation is going to moderate. The Fed have got it right. If you look at break-evens, they've really kind of collapsed across the curve over the last week or so. If you look at employment, again, there's multiple different angles as to why net employment has undershot. But generally, without fitting too much of a tight narrative to this, because you can look at it in multiple different ways, I think that markets are actually just setting in for summer. And we're going to start seeing this generally. We've got the ECB as well today, US inflation, and then the Fed next week. And then really we're not going to see any kind of major policy announcements from these two central banks until Q3. So I think markets just generally are setting in for something which they consider tolerable to hold on to for the next month or so, until we come into Jackson Hole in August. And that's really where they're at with it, because inflation, we've already had that upward surprise in April. We know inflation is going to be hot in the near term, and it's almost a case of, well, the Fed hasn't changed its stance then, so why would it now? 1 month and 2 months worth of data doesn't define a longer term trend for markets.
Okay, and so if we're settling in for summer, Simon, where does that leave the dollar? I'm looking at the Bloomberg Dollar Index, and it's sort of, it's a tale of, this year has been a tale of two quarters. The first quarter sort of heading higher on that dollar index, the second quarter heading lower, and we're kind of back to where we started the year on that particular index of the dollar. Where do you see the dollar heading then? Is it just going to tread water for the summer?
Yeah, I think we're going to start to see very, very mild depreciation. We still think that the structural dynamic in the dollar across the G10 currency board and in some EM pockets is still intact. So we're not going to see the kind of the big unwind in the US dollar that we've seen over the second quarter, but we are going to see continually that the Fed's messaging will begin to continue to weigh on the dollar somewhat. The kind of the growth story elsewhere in the world chips away at the US's kind of exceptional growth story. Stimulus in the US could change this dynamic in Q3, but it doesn't look like that's coming anytime soon. And I think we're really settling in for a mild depreciation in the US dollar over the course of summer. But really, with regards to the trend of FX markets for the next month or two, I think we're going to see almost a stagnation. And this is why we're looking for the ECB meeting today and the Federal Reserve meeting next week, because they're really going going to set the tone of how policy is going to trade throughout summer. And these policy expectations are really going to be set in stone from these two meetings and define how the broad dollar, especially against the G10, trades.
Simon, thanks very much. Thanks for giving us your time this morning. Simon Harvey, Senior FX Analyst at Monex Europe. Thanks for setting up that US data for us a little bit later on today. Also on our radar, the ECB meeting. ECB officials seem unlikely to spring any surprises over stimulus at today's meeting, but there could be a lot of interest in talking about how the ECB does eventually unwind policy and the latest forecasts coming through from the ECB. All of that's going to be really very much in focus. So also the German political backdrop and the digital euro. We wonder if they'll be asked more about those topics today. This is Bloomberg.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold in economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
We are certainly not at a level where inflation would be a danger in Europe. In the US, it's different.
I do believe that there is now a significant inflationary danger.
I think that what we're seeing now in inflation is going to turn out to be transitory. It's hard to imagine a big wage inflation spiral at this point in time.
This year's inflation times are very much the healing of last year's artificial pandemic-driven shock. But it would be, I think, wrong to think of this kind of environment as the new normal.
European inflation is still a lot lower than in the US, and our recovery is a bit behind.
When it comes to 2022, we expect that headline inflation will drop back down to around 1%, a significant drop.
We are watchful because we have never experienced in the past a recession that was self-inflicted.
Some thoughts on European inflation concerns there coming from many different places. Now let's keep it on Europe. And ECB policymakers have all the evidence they need to keep ultra-loose monetary stimulus in place today, thanks to the Fed That's part of the story, at least. After ramping up their bond buying program in the second quarter to keep borrowing costs in check, it's time for officials to settle on a new pace for the months ahead. The central bank is also due to update its economic projections. Joining us now from Frankfurt is Bloomberg's Maria Tadeo. Maria, thanks for the update. Can Christine Lagarde walk then this fine line between an improved outlook on the one hand and wanting to say, look, the European economy is doing better, but at the same time avoiding talk of tapering the stimulus that the ECB has been introducing?
Yes, Anna, you can see why this is very tricky. Now, we're not expecting any changes to the policy itself, but that press conference will be very important. Now, as you say, we are expecting that those projections for both GDP and inflation will probably revise. They will probably be improved. There's a real conversation in Europe as to whether inflation dynamics are similar to those in the U.S. or whether this is just really a one-off. When you look at the economy too, Anna, this is a very different scenario to the start of the year, where coronavirus, of course, was rampant across Europe. There were lockdowns that were really taking off steam from the economy. Now the picture is different. You know, we've seen vaccinations pick up and there's momentum building into the second half of the year. So on that note, it'll be interesting to see whether on the PEP program and the pace of those purchases, the language will stay unchanged, that significantly higher reference. And the way that the market is positioned for this, they want to avoid anything that looks like taper talk. If you do get a hint, perhaps, that does signal some of that tightening, then you could maybe see a sell-off in the market today. Again, the market is not positioned for that today, and that could be a shock. So the language in that press conference will be very key for Christine Lagarde.
Yeah, so just to be clear, we're looking for that, a restatement of that line, a significantly higher pace of buying versus the first months of the year. That's what they said in March. So it's the word significant and higher pace that the market is going to focus on, I suppose. In terms of the strategic review, though, looking longer term then, Maria, at the ECB's mandate and what it's all about, we're expecting a 3-day retreat from the ECB to kind of invigorate that debate. So what are we looking for there?
Yeah, it is. And that's the idea, really, to inject some new life into that review. Remember, this was really the big story for the European Central Bank before the pandemic hit, and of course was suspended for much of 2020. Of course, the focus on that is very much about the inflation target. That's a real debate also in Europe about what the target should be for that, what measures or what numbers and which benchmarks should be included for that, and what criteria. You know, there's many analysts that will tell you going into the future that inflation target is not about the number, but also components, and things like housing costs should be included in that. It'll be also interesting to see, you know, what they say about climate. That's something that Christine Lagarde has many times stressed that should be a much bigger determinant factor in the economy and the risks that it could also pose going down the line in the future and the economy overall. So it's a review that is looking to re-inject some life into that debate, and it'll be interesting to see what comes out of that retreat.
Maria, thank you very much. Maria Tadeo joining us there in Frankfurt, teeing up our coverage of the ECB. It will indeed, as she says, be an interesting press conference to watch in terms of the balancing act that Christine Lagarde has to strike there. Also worth mentioning, we've got US futures moving a little more negative right now, down by 0.2% now on NASDAQ futures, 0.1% to the downside on E-minis. We'll return to that theme shortly. Let's go to Bloomberg Business Flash. Here's Juliet Sali.
And Democratic Senator Elizabeth Warren says the US government needs to step up oversight of the cryptocurrency market. Warren told Bloomberg TV the market for digital coins is the Wild West. She said more regulation is needed to protect consumers from scams. Bloomberg has learned that United Airlines is in advanced talks to buy at least 100 Boeing 737 MAX jetliners. It would be part of a broader fleet revamp. United sees it as a chance to upgrade at a time when Boeing and Airbus are hungry for deals. Facebook says it will let all employees work remotely even after the pandemic if their jobs can be done from home. But the world's largest social network said it may reduce workers' pay if they move to a less expensive area. It plans to open their US offices to 50% capacity by September. And that is your Bloomberg Business Flash. Anna.
Juliet, thank you very much. Juliet Sali in Singapore. Coming up on this program, more than 12 million electric passenger vehicles are now on the road. But despite rapid uptake, Bloomberg's new energy finance team says it's not enough to reach net zero by 2050. We'll have the details next. This is Bloomberg.
U.S. financial sector has made some progress with minority and female inclusion, but any momentum has slowed in the wake of COVID-19. I'm Francine Lacqua, and we'll take a look at the pandemic's unequal impact on financial services. We'll delve into the data and some of the reasons behind the drastic drop of women in the workforce. We'll also get the views of two very senior women in the industry on creating an inclusive environment, retaining talent, and the future of work. All in our latest Money and Equality special this weekend on Bloomberg Television.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
U.S. relations with traditional allies frayed under Donald Trump. President Joe Biden has vowed to repair this. One area where the group should find common ground, it stands towards China. The world's largest democracies are increasingly determined to combat China's rising influence, be it in so-called vaccine diplomacy or the pace of reducing its reliance on coal. Along with discussing pandemic response and vaccine distribution, leaders will consider climate change, with every G7 nation expressing support of green goals. This meeting offers a chance to craft a strong common message, but the debate over details could expose divisions. President Biden, Italy's new Prime Minister Mario Draghi, and Prime Minister Yoshihide Suga of Japan will be attending their first G7 summit as leaders, while be Angela Merkel's swan song. She's leaving office after 16 years as Germany's chancellor. Her departure will surely alter the dynamic at global gatherings of democratic nations such as this.
That was Bloomberg's Anne-Marie Hordern on what to expect from the G7. More on that crucial meeting in Cornwall in the southwest of England throughout the show. Let's get back to these markets then. I mentioned that US stocks futures are a little bit more negative than they were, and we're certainly keeping an eye on that. NASDAQ futures down a couple of tenths of a percent. Let's get to some individual movers, though, here in Europe, where European equity markets are, broadly speaking, flat this morning. Sainsbury's moving to the downside, down by 2.4%. Cut to hold at Jefferies. BT Group up by just over 1%, as Altice UK likes what BT is doing on fibre, it seems, or at least wants to be part of that, and takes a stake in BT Group. Stellantis is down by 1.9%. This is the automaker, of course, and the French part of that business now facing French charges over diesels, joining VW and Renault in that particular probe being run by French authorities. So those are some of the stocks that are on the move this morning. Let's get a Bloomberg First Word News update. For that, here's Juliette Sali.
Anna, the US plans to buy 500 million doses of Pfizer's coronavirus vaccine to share internationally. The word came as President Biden prepared to join other group of 7 leaders in a campaign to end the pandemic by distributing shots worldwide. The G7 leaders have gathered for their summit in the UK. Well, President Biden and British Prime Minister Boris Johnson will commit today to resume travel between the two countries as soon as possible. It's not clear how soon that really will be. The two leaders are meeting, of course, ahead of the start of the G7 summit, and they'll launch a joint task force to explore travel options. Myanmar's military junta has formally charged detained civilian leader Aung San Suu Kyi and other officials with corruption. The country's Ministry of Information said she was found guilty of committing corruption using her rank. If convicted, she could face up to 15 years in prison. Suu Kyi and ex-President Win Myint have been held by the military since a February 1 coup. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anna.
Juliette, thanks very much for that. Juliette Sali with your update there from Singapore. Now, there are now more than 12 million passenger electric vehicles on the road, with uptake rapidly rising in recent years. But despite the move towards EV adoption, road transit is still not on track for carbon neutrality by 2050. According to Bloomberg New Energy Finance, aggressive policy action is needed and the window of opportunity is closing fast. Joining us now here on set in London, Colin McKerracher, who's Bloomberg New Energy Finance Head of Advanced transport. Very good to speak to you. Thanks very much for joining us, Colin. Let me start by asking you about the geography of this. So we talked there about EV adoption and where it is working and where it's a little sluggish. Is China still leading on this?
China is still leading, but Europe is also going quite quickly. So right now, actually, European adoption of electric vehicles, of plug-in vehicles, about 15% of new sales right now. China, it's more like 10 overall, but more of them are pure electric vehicles. And China's a bigger auto market overall. So China, Europe, the leaders. North America, still a fair ways behind, sort of in the 2-3-4% range of sales.
And we started this conversation with a slightly gloomy, well, very gloomy, I suppose, statistic that if we carry on at this rate, we're not going to we're not going to be carbon neutral. So for governments that want to reduce emissions, do they need to be doing something, changing policy, encouraging, incentivizing faster adoption of EVs?
Yeah, this was one of the big findings from the report that we did this year, is that things are going fast. You hear about it in the news, it's all happening, but actually it has to go a lot faster. When you look at these long-term targets out to 2050 and you start working back what has to happen today, you really need to get adoption really high. About the last internal combustion engine vehicle really needs to roll off the line globally around 2035 in order to stay on track for those long-term targets. So that means immediate policy action today. That means things like tightening fuel economy regulations. That means support for charging infrastructure. All of the above are going to be needed to keep us on track.
Yeah, I know from prior experience trying to buy electric vehicles that sometimes the lead time is very long and the charging infrastructure just is incredibly patchy. I mean, and that's even if you have somewhere to charge the thing at home, which doesn't apply to a lot of people. So what are the barriers that are standing in the way? Let's talk about Europe then. What are the barriers that stand in the way of faster adoption?
Yeah, the lead times are coming down, so more and more automakers are getting very serious about their EVs. They've got these dedicated EV architectures. They can roll out more models. They can crank out production faster. That's going to go away over time. That should be fine. The part about charging infrastructure, you do need more investment. We calculated over the next 20 years, you need about $590 billion of investment in charging infrastructure, but a lot of that is actually just individual people buying chargers for their home. Still, for a lot of those people who don't have home chargers, you do need robust public charging infrastructure. And to get to those higher levels of adoption, people do really need to feel confident. So there is a significant amount of investment that's needed. If we compare it to the amount of investment that's going into renewable generation right now, that's about $300 billion a year. And we're talking about around $600 billion over 20 years. So this is probably a manageable amount of money, but there's certainly still a lot of work to do ahead.
And what does this do to oil prices? Thinking broadly about the sort of energy spectrum, if we're transitioning to different types of cars and we're transitioning across the economy to different energy sources, a lot of oil companies under pressure to invest less, of course, in oil and more in alternatives. But how much, what are your expectations for what this does to oil demand?
In the long term, this is pretty grim for oil demand. I mean, we ran two scenarios, our sort of base economic transition scenario and then this net zero scenario. And in both of them, the outlook for oil demand in the long term is quite grim. It does still rise a bit in the next 5-6 years, peaks around 2027 and then starts to come down in our outlook. Exact impacts on prices is very hard to say because, look, it matters what happens both not just on the demand side, but also the supply side there. So we didn't really look at that. But on the demand side, the outlook is pretty gloomy in the long term for oil demand.
Okay, that's a really interesting conversation, and thanks for bringing us the details of your report, Colin.
Thanks.
Good to speak to you this morning. Colin McCurricker, Bloomberg New Energy Finance Head of Advanced Transport. Thanks to Colin for bringing us that report. Coming up on this program then, as President Biden meets other members of the G7, cybersecurity looks to be high on the agenda. Following increasing hacks on U.S. infrastructure, the U.S. president may seek support for his tough line on China. He's also been outspoken about Russia in the last day or so. We're live in Cornwall for a preview of the G7 meeting next. This is Bloomberg.
Vietnamese people have shopped at wet markets or mom-pop stores for decades, and now e-commerce companies are trying to change this habit. Those including regional players like Shopee or Lazada or local startups Tiki have been building loyalty and trust by providing Vietnamese with services that are common in developed economies but very new to this country.
Mình chỉ cần ngồi ở một chỗ thôi và lên một cái trang web chẳng hạn thì mình có thể tìm được là rất nhiều cái mặt hàng ở trên đó. Thứ hai nữa là về cái tốc độ giao hàng thì bây giờ cũng đã nhanh hơn rất là nhiều rồi, thậm chí là có những cái mình có thể nhận sau 2 tiếng như Tiki Now chẳng hạn.
The epidemic has given digital retail a boost, with more Vietnamese buying everything from food to electronics online.
Còn một cái nữa đó là tại vì cũng đang dịch ấy, thế nên là nếu mà mua hàng online thì sẽ an toàn hơn cho tất cả mọi người, bởi vì là mình sẽ không cần phải ra ngoài và tiếp xúc với nhiều người.
The country's e-commerce is expected to reach 29 billion in 4 years, from 7 billion last year. The government is also encouraging this sector with target of online shopping to account for 10% of Vietnam's retail sales by 2025.
Curtain will rise again.
Broadway's returning June.
If you bought tickets,
It's busted out.
You've got more time here. If you want
Commodities are up.
Keep going.
To the moon.
Beautiful.
Bloomberg Surveillance, weekday mornings on Bloomberg Television and Radio.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome back to the European Market Open. Half an hour into our trading session, and European equity markets a little bit sluggish. US futures also a bit sluggish. Dow futures actually flat. S&P futures pretty flat, so it's Nasdaq futures that are maybe leading sentiment a little lower, down by 0.2%. The FTSE 100 keeps its head above water, but elsewhere we lose a little bit of ground here on European equity markets. Looking at things from a sector breakdown, we've got technology and healthcare and basic resources to the upside, so that the third of those certainly adding some upside to the London market. Travel and leisure is one of the biggest declining sectors. Autos and parts also weaker. That will weigh on the DAX, which is down 0.3% this morning. In terms of travel and leisure, we do see some weakness in some of those aviation stocks. Ongoing speculation about will we, won't we open up perhaps further in the UK on June 21st. So EasyJet, Wizz Air and Ryanair all down by more than 1.7%. Back to the geopolitics now. US President Joe Biden and other leaders of the G7 countries are gathering in Cornwall in the United Kingdom. Top of the agenda is a plan to end the pandemic by the end of 2022. In Cornwall for us is Bloomberg's European close anchor, Guy Johnson. Guy, very good to speak to you. We've seen the draft communique then here at Bloomberg from the G7 already, so we have some sense certainly of what is on a very diverse agenda. What are the details?
So what we know from the communique, Anna, and the headline from it really is that there is going to be this push to basically vaccinate the world by the end of next year. 1 billion vaccines are going to be delivered. That will cover around 80% of the world's population. This delivers a number of different things for the G7 leaders. First of all, there's the humanitarian aspect of this. They want to be perceived as doing the right thing. The second, probably most crucially, is that if the G7 didn't do this, then there would be an opportunity maybe for China to step in and do the same thing. And very much a focus of this summit is going to be a pushback against China and against Russia. We'll return to that in just a moment. The third aspect of this as well is climate related, Anna. Many of the poorest countries around the world are simply saying, why should we sign up to your climate pledges when you are not providing us and our populations with the kind of assistance we need to come when it comes to fighting COVID? You help us with this, maybe we can help you out with that. Now, Boris Johnson obviously has the COP conference coming up in Glasgow later on this year. He wants to lay the foundations for that. He wants everybody to be on the same page, and he wants to deliver kind of tidal wave of enthusiasm to get something to happen at that conference. Climate and COVID therefore intermingle, and it is important that the G7 provides this kind of window to be able to deliver these huge numbers of vaccines. Anna.
Yeah, really interesting, that vaccine focus, the global vaccine push that we're now seeing coming from the United States. I know that we've had a piece out this morning talking about some frustration in some parts of the euro area or within the EU that maybe it's taken a while for that message to get through stateside. What else are we going to be looking out for then? Because as I referenced, there are a lot of things on the agenda.
There are lots of things on the agenda. From a US point of view, it is about the 3 C's. It is about climate, it is about COVID, and it is about China. I'm going to throw Russia kind of next to China. There is a pushback, certainly from the US point of view, democracies pushing back against autocracies. There is going to be a meeting next week between Joe Biden and Vladimir Putin. I think Europe and the United States are broadly on the same page when it comes back against pushing back against Moscow. I think China, Anna, is where the difficulty lies, and I think this is where frustration again comes between Europe and the United States. The United States very keen to push back against China, sees it as an enemy, and Europe's taking a slightly different tack. And it's going to be interesting to see whether or not there can be some meeting of minds, particularly when it comes to finding a way to push back against China. Certainly, that's what the United States sees this summit about. Finding a club that can make that happen, a club of democracies.
Guy, thank you very much. Guy Johnson with us from Cornwall. Beautiful views of St Ives in the background, getting ready for the G7 and dealing with all that background noise, something reversing, hopefully not too close to Guy Johnson's camera position. Now, as leaders gather today for that G7 meeting, Joe Biden will seek support from European partners with his tough line on China. One way for Biden to convince them might be the recent concerns about cyber attacks and alleged spying on German Chancellor Angela Merkel via undersea cables. A new cable, the first one manufactured entirely by China, will soon emerge off the coast of the south of France. The United States has refused to use it. Huawei, the company at the center of a long simmering struggle between China and the US, is the third largest shareholder in the company building that cable. We are joined now by Huawei's Chief Security Officer, Andy Purdy. The company has just launched its biggest cybersecurity and privacy protection transparency center to perhaps change the story a little bit. Andy, very good to speak to you. So you're launching this privacy center in the face of all of that Western criticism. I wonder what your aims are. What are your hopes that you can achieve with this Privacy Protection Transparency Center in China?
Well, this is really part of a 10 or 11-year effort by Huawei to build and strengthen a cybersecurity assurance system and to provide transparency, meaning giving the ability of stakeholders, governments, regulators, our customers, and providing value to them so that they can come in and they can test our products. And we encourage our competitors and others to open similar transparency centers because it's important that there be independent verification. We also released our practices of managing cybersecurity, our security baselines, our legal compliance, our requirements for secure coding, compilation, sensitive data, all those technical things, and encourage folks to talk with us about how these can work together. But also, I think there's a fundamental message of collaboration. I note that President Biden will be meeting with the G7. Collaboration is critical to bring the benefits of technology to the world. It's critical to address the shared responsibility of risk, and it's critical to close the digital divide and promote greater inclusion.
The US has not wanted to collaborate with Huawei, though, in recent years, Andy. I mean, the US government has accused Huawei's networking equipment of containing backdoors that cyber attackers or nation states can then exploit. Is anything that you're presenting at this security center, at this transparency center, is it aimed at changing that US view?
No, it's not aimed at changing that US view. In fact, it builds on the reasons that I accepted the invitation to join Huawei 9 years ago to help promote a safer cyberspace. And collaboration, international standards, I'm glad to see the G7 is going to be talking about, and Europe generally going to be talking about greater standards. We need standards. We need conformance programs. We need independent testing because these recent cyber attacks of SolarWinds and Microsoft Exchange servers show that the concept of a trusted supplier is no more. We can trust no one. And that's why President Biden's executive order on cybersecurity emphasized zero trust. We all have to work together to make a safer cyberspace so we can get the benefits of this digitization future that we're in.
Your company has had, as a reference, a pretty contentious, a difficult relationship with the Trump administration. Some of the signs more recently under President Biden look a little better at the sort of nation-to-nation level. Certainly, if you look at the social media bans that have been lifted, if you look at the fact commerce secretaries are talking between the US and China, do you think that Huawei's position is going to be reviewed by US authorities?
Frankly, we're much less concerned about our ability to do business in the United States. We're concerned about how can we work together to promote a safer cyberspace. We're encouraged that President Biden is not just doing things to block us. He is trying to promote the competitiveness, the technological competitiveness of the United States. He's trying to help promote our semiconductor industry. And some of these changes in executive orders are trying to come up with evidence-based findings for deciding who is worthy of trust. And the collaboration with the NIST standards body, hopefully working with ENISA and GSMA in Europe, hopefully we're going to come up with stronger standards, but we need greater transparency like our Transparency Center, but we need much greater accountability for companies and for governments, and that includes on the international stage.
So what are the prospects of Huawei getting off that US blacklist, Andy?
Well, we don't think that's a major priority for the Biden administration right now. We recognize that. There are bigger fish to fry. The challenge of making America safer for cyberspace has been revealed in some of these recent executive orders. That's what's really important. And we hope that we can talk with the U.S. government. We'd like to collaborate. We've been very active in the global standards efforts, working closely with our competitors, Nokia and Ericsson and others, for example. This is the kind of thing that really takes precedence. But the ability of American companies to sell to us, there are at least 40,000 direct American jobs on the line. So hopefully there can be a dispassionate focus on what is in the best interest of the United States, including the U.S. semiconductor industry.
Andy, given that you are still on that blacklist, of course, and the U.S. has those views about backdoors that allow cyber attackers or nation states to exploit, your smartphone business has faced challenges as a result. How much has the blacklisting hurt the cell phone business at Huawei?
Well, our computer device, our mobile phone business has been severely hurt by the export controls that limit the sale of non-sensitive semiconductors to Huawei. So we don't have the full supply of the chips. Plus, for a reason we still don't understand, the U.S. has blocked the ability of Google to work with us on Android. Having us work with Google, a trusted company with this international platform for mobile devices, that would make everybody safer. So those have definitely had an impact on our revenues, but we're going to get through it.
Andy, thanks very much. Thanks for coming to talk to us today. Andy Purdy, Huawei's Chief Security Officer. That company, as we said, still on the US blacklist. And interesting to see China-US relations still at the heart of that G7 conversation. Coming up here on this program, tuning an IPO. Shares sink in Believe's debut in Paris, one of the highest profile flotations this year in the French capital. We'll speak to the CEO of the digital music company next. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between governments and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax
in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
The power of Bloomberg. First on news.
Headlines crossing from Morgan Stanley. It's a management shake-up, planning for transition in 3 years potentially.
This is a huge move over at JP Morgan. It is a shock, of course, to the market.
First on earnings.
Apple, a big beat, well ahead of the 33% increase in revenue.
First on markets.
The capitulation phase is buy.
The power of the Bloomberg terminal. The power of Bloomberg television and radio. Bloomberg has it covered.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Welcome back to the European market open. 8:43 here in London. European equity markets flat overall. Some upside in London, some downside in Frankfurt. Let's just have a quick look at what's coming through from Singapore this hour. A red headline across the Bloomberg tells me that Singapore is to relax its COVID rules in stages as virus cases dwindle, which has to be good news. And we're getting a host of lines coming through around some of the measures they are taking to do that. Work from home remains the default to manage risks. That's one that might be of interest to people. They're going to start vaccinating citizens aged 12 to 39, so bringing down the age range in terms of those vaccine rules. And they are relaxing COVID rules then in stages. Mask travel rules to ease only when more people are vaccinated. So things not changing overnight, but certainly an interesting update coming through from Singapore. Now let's talk about what's going on in these markets. And in terms of IPOs, a digital music company, Believe, has gone public in Paris today, falling in its debut below its IPO price of €19.50. The company is seeking to raise 300 million euros, cashing in on the booming growth for streaming during the pandemic. I'm pleased to say that we're joined now by the CEO of Believe, Denis Ladegaieri, who's with us this morning from Paris. Denis, very nice to speak to you. For those who are not familiar with the business, tell us what it is that Believe does in the digital music space.
Well, good morning, and thank you for having me. It's what we do. Believe's mission is to develop independent artists and labels in the digital world, and the way we do that is by providing solutions to artists to help them develop their audience at various stages of their career, from new artists all the way to top artists.
And are you, with that in mind, what do you plan to use the money for, the money that you're raising today with this IPO?
Well, you know, we expect that by the end of this decade, digital music will represent 80% of recorded music revenues. And so, therefore, we're going to invest in building local teams in all of the territories we operate to be in close proximity and support local independent artists and labels in their development. We have many acquisition opportunities in territories, and we expect to do about 100 million euros in new acquisitions each year in the next 3 years. And then we're going to continue investing in our digital expertise and in our technology platform to bring better solutions to artists.
What are the kind of deals you'll want to do then, Denis? You've been buying up labels. You're not, in a traditional sense, a music label. So what are the kind of assets that you need to add?
You know, we are in a world that's transforming very rapidly. So we look for either traditional labels that are looking to accelerate their digital transformation, and then we help them grow faster by repositioning them, making our technology platform, our digital expertise available to them. And there's also a new generation of very digital-friendly labels. They understand how to leverage TikTok. They understand how to leverage YouTube, digital music platforms to grow, and they raise very fast. And generally, they're looking to us to help them accelerate their growth even further. So this is typically the type of opportunities we're looking at across all of the markets where we operate around the world.
You listed today at €19.50 a share. You priced at the bottom range of what had been anticipated, which went as high as 22.50, and you're trading now at 17.50. Dennis, are you a bit disappointed with the first, I suppose it's just 47 minutes of trading, but down 10%? How does that sit with you?
No, quite frankly, I think our view has always been from the very beginning, from the creation of Believe 16 years ago, that this was a long-term market transformation. We're super confident. We're riding on markets that are where streaming is growing very quickly, where we see the rise of independent artists and labels. We've signed more of them in the first quarter of this year than ever in our history, and that will drive future growth for us. So we're extremely confident in the long-term growth potential for the company, and which is why we listed.
Yeah, no doubt focusing on a longer-term horizon than the 48 minutes I gave you there. How do you think that COVID has accelerated our adoption of digital music then, Dennis? This has been certainly a phenomenon that has been sped up by the pandemic. What's your take on that?
Well, what we saw is two things during the pandemic is, as you know, some of the artists were locked down in their home, like many of us, and so therefore they didn't release music for some time, and obviously for us, some of the advertising based services like YouTube are important sources of revenues, and we saw them grow less in 2020 than they did before. What makes us very optimistic is that we see all around the world now concerts reopening, venues reopening. We've had many artists in the first quarter, and in this coming quarter we will be releasing music that they have been holding on. So we do think that the markets are now reopening, and it has accelerated the transition. I think there's more and more artists now that realize that we do live in a digital world, and that digital world means digital artist development. It means digital marketing, digital promotion. This is what we do much better than the traditional players out there, and this is what makes us very attractive to artists. So what we anticipate is, as all of the countries reopen, we're going to see an accelerate trend and growth and attractivity to artists.
Dennis, thanks so much. Thanks for bringing us the story. Thanks very much for coming to talk to us here at Bloomberg TV. Dennis Ladegaieri, the CEO of Believe. Coming up here on this program, lots for investors to keep an eye on today, with an ECB meeting, US inflation data, all on the agenda, plus the G7 taking place in Cornwall. We'll dig into some of those themes with Laura Cooper from our Markets Live team next. This is Bloomberg.
revenues coming in better than expected, everything. Cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Welcome back to the European Market Open. 53 minutes into our session. The overall is flat, but shows some serious divide between what's going on in London and in Frankfurt. Let's get to Laura Cooper, Bloomberg Markets Live macro strategist. Laura, good to speak to you once again. What on earth is going on here when we wait for this really high inflation number that many people anticipate we'll get from the United States later, and yet bond markets rally and yields drop below 1.5%? What's the story?
Well, and I think that's been really what's most surprising over the past couple of days, just this epic bond rally that saw 10-year yields break out of that range that they've been in since early March in the U.S., now below 1.5%. And I think that does tell us that markets are convinced that this inflation pressures are going to be transitory. They are convinced that the Fed is sticking to that employment side of the mandate. There's still a lot of room there. So even if we do see near-term price pressures to be confirmed in that CPI print today, really markets are going to potentially look through that, and as the Fed is going to look through that. But again, it's another catalyst that will that actually change the narrative today? It remains to be seen.
Yeah, I remember seeing one of our colleagues setting it out as, you know, if it's a really strong number, then markets might just say, well, look, the Fed is actually looking at the jobs market instead and focus attention there. So that could be part of the mix as well. Laura, the ECB also in focus, not necessarily so hotly anticipated as a market-moving event for the decisions that will be in the statement, but we will get a press conference, and that conversation could roam, and we'll get some updated forecasts from the ECB.
Yeah, I think, you know, this meeting may have been more exciting if it had happened, you know, before the ECB members really came out and quelled these expectations. They're unlikely to scale back their bond buying today. They're going to likely keep the pace of PEP purchases around that 85 billion mark over the coming 3 months. But again, like you mentioned, it's all about Christine Lagarde. Will she have a hawkish tilt today in that press conference, which could see bond markets once again brace for that tapering ahead? If we look at what's happened in the key proxy of financial conditions, though the BTP Bund 10-year spread, that did widen by about 20 basis points from that April 22nd meeting through mid-May, but that's come off quite a bit. And so spreads, yes, they're wider than last ECB meeting, but certainly not something to be concerned about. And I think the ECB is quite happy with that. They want to continue to contain those spreads. So it would be a fine balancing act for Christine Lagarde today.
Laura, thank you very much. Laura Cooper, Bloomberg Markets Live macro strategist. Thanks very much for bringing us a heads up on what to watch on the inflation story out of the United States and indeed the ECB. And all of those things will be happening, or both of those things, I should say, will be happening at the same time, early afternoon, of course, and we'll continue to bring you coverage of that US data and the ECB press conference, where the conversation could roam and therefore could get into some interesting territory. As we were just mentioning, we will also have running in the backdrop the G7, of course, taking place in Cornwall. Now, that is it for the European Market Open. Surveillance Early Edition is up next. European equity markets look like this, flat right now. The FTSE 100 lifted a little bit by healthcare stocks and basic resources. The DAX under pressure because of autos. That is it for the European Market Open. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
More has to be done. Countries that have surplus doses, we have to share some of those doses.
We are certainly not at a level where inflation would be a danger in Europe. In the US, it's different.
We're not seeking conflict with Russia. We want a stable, predictable relationship.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition on this Thursday, the 10th of June. I'm Francine Lacqua here in London, and here's what's coming up on today's program. President Biden arrives in the UK for the G7 Leaders Summit as the world's richest countries vow to deliver 1 billion extra vaccine doses over the next year. The ECB is set to review the pace of its pandemic bond buying program. Treasuries climb ahead of a crucial U.S. CPI print this afternoon. And meme stock mania gets a second lease of life as the SEC plans to review stock trading rules, while GameStop reveals a new leadership composed of Amazon veterans. So, our top story, let's get straight to it. The G7 Leaders Summit in the UK this weekend starts with some positive momentum after finance ministers reach an agreement on a landmark deal to overhaul global tax rules. As a group comes together face-to-face for the first time since 2019, many important issues remain on the table. Anne-Marie Hordern has a preview.
U.S. relations with traditional allies frayed under Donald Trump. President Joe Biden has vowed to repair this. One area where the group should find common ground, it stands towards China. The world's largest democracies are increasingly determined to combat China's rising influence, be it in so-called vaccine diplomacy or the pace of reducing its reliance on coal. Along with discussing pandemic response and vaccine distribution, leaders will consider climate change, with every G7 nation expressing support of green goals. This meeting offers a chance to craft a strong common message, but the debate over details could expose divisions. President Biden, Italy's new Prime Minister Mario Draghi, and Prime Minister Yoshihide Suga of Japan will be attending their first G7 summit as leaders, while be Angela Merkel's swan song. She's leaving office after 16 years as Germany's chancellor. Her departure will surely alter the dynamic at global gatherings of democratic nations such as this.
Well, in the southwestern coast of England, in Cornwall, for us is Bloomberg's European close anchor, Guy Johnson. Guy, I hope you're enjoying the warm weather, which is quite a rarity in the UK. But we've seen this draft communique from the G7 already. What are the details?
Well, two things to say. First of all, unfortunately, the weather is not that clement down here. We were hoping for sunshine. That is not the case. It has just stopped raining, which I guess is a positive. We have seen the communique. The focus of the communique, Francine, is on what is happening with the vaccine narrative. And what we're seeing here is that there is an expectation that the G7 leaders will commit to vaccinate 80% of the world's population by the end of next year. Now, this fulfills a number of different objectives. First of all, it obviously gives the G7 a humanitarian aspect, which I think most of the leaders will welcome. It also brings together potentially and deals with some of the differences over vaccine distribution that have divided Europe and the United States. But it also has a number of different other positive aspects, Francine. The first one is that it provides an opportunity to fill a gap that China could potentially fill. So the G7 will commit to do this, therefore denying China the opportunity to step in and provide that sort of diplomatic push on vaccines. The next kind of important aspect to this is what is happening with climate. Many poorer countries are saying, why should we fulfill your climate pledges if you are not providing us with vaccines? Boris Johnson's COP conference coming up in Glasgow later this year on climate, hugely important to him. He wants to make sure that these countries don't have that reason to say, we can't deal with the climate narrative because you haven't given us the vaccines. He wants to commit to those vaccines so they commit to the climate narrative. Francine?
Guy, how much, limelight will the Brexit issue and the fact that actually, the UK and the EU are once again almost on the brink of very, fraught relationships, and will the US intervene in that?
Well, so, okay, let's. There were talks yesterday in London between Lord Frost and Maria Sefcovic. They didn't go anywhere. They didn't break down, but they didn't provide progress. And that obviously is a cause for embarrassment to a certain degree for the UK coming into this. Nevertheless, the UK, I think, probably is unlikely to see significant criticism from the US. I think the British papers this morning are making much of this. Certainly the narrative we're getting from the US side is that actually the US is unlikely, Joe Biden is unlikely to criticise Boris Johnson on Brexit. He will, at a very elevated level, suggest that he is very keen to make sure that the Good Friday Agreement is upheld, and he will lean heavily on his Irish roots. But he is unlikely to step in and rebuke the UK. He is unlikely to step in and really get into the granularity of what is happening here with this Northern Ireland Protocol, Francine.
Oh, that's really interesting. Guy, thanks so much. That was the European close anchor, of course. Our Guy Johnson covering the G7 for us over the next couple of days. In the meantime, we're also getting some CPI figures here, well, in the U.S. a little bit later on. Here it's the ECB, so let's quickly get onto your market check. We continue looking at the rally in treasuries that we saw. For the moment, futures are actually pretty much steady. I'm also looking at Asian stocks. They rose a little bit because of this U.S.-China talks, helping sentiment and bolstered the offshore yuan. Then treasuries are rallying again. That's ahead of this U.S. inflation report that may provide clues on the monetary policy outlook. And then separately, President Biden did revoke this Trump-era bans on TikTok and WeChat, so that may have a little bit to do also with Asian sentiment. Joining us to talk about the G7 and the markets is Stephen Major, HSBC Global Head of Fixed Income Research. Stephen, thank you so much for joining us. Always a pleasure. There's a lot to talk about, actually, when it comes to treasuries and the rally that we saw. How are you viewing, first of all, we'll get to CPI in a second, but how are you viewing the G7? Is it communiques that don't actually move the markets, or could we see something substantial?
Well, I suppose some of the news that might matter has already come out, and that was on tax, wasn't it? Markets will interpret that, particularly bond markets, and they'll try and do the calculations on what it means for fiscal policy. So that's something. There's a lot more that we don't know, and of course, everyone's going to be watching in case there's some kind of political announcement that disrupts markets. But you don't hold your breath. These meetings don't tend to cause much trouble.
Stephen, first of all, when you talk about tax, I mean, does it actually change your view on anything in the markets? Because it seems that, a couple of countries are now asking for exemptions, and it could take also, years for anything to be concrete.
Yeah, I mean, that's fair enough, Francine. And whatever revenues come in are just filling a hole. So there's been a lot of money spent and committed already. But to me, it's part of a bigger picture. And when it comes to the US, there's going to be a deficit ceiling debate coming up. And it's difficult to see how we can have the same kind of fiscal largesse, again, the same kind of fiscal impulse. So to me, it's a reminder that there is the threat of higher taxes in all kinds of different forms. Though this is at the margin, admittedly, but it's a sign of things to come.
So, Stephen, in terms of things that matter, inflation matters. If we have an uptick in inflation, how much of it is already priced in?
Yeah, well, in terms of what matters to bonds, I think that it's the Fed effect on yields that matters. And the Fed is saying they have an average inflation target. And it seems that the market might be listening, which to me means when you get a 4 or 5% handle on the CPI, it's largely expected and factored in. We've spent much of the last 6 to 9 months preparing for this moment. So markets move ahead of the data. And I think that people are slowly coming round to the idea that the Fed might be right. And that's despite the stampede of people who are coming on your show and elsewhere talking up inflation.
We also heard from the Chinese central bank governor, I think today or late last night, actually saying that everything should be within their forecast in terms of inflation. Is there a chance that we're actually going to be importing inflation from China?
Well, the two numbers that came out of China, one had a 9 handle, that's 9%, that's PPI, and the CPI had a 1 handle. I think the core number was even less. So there's no transfer of the producer price pressure onto the consumer level. So at the moment, I don't think we should worry about that. And it's a question of whether the cost increases can be passed on. And so far, China's giving a great example of how that's not happening.
Stephen, thanks so much. Stephen Major there of HSBC stays with us. We'll talk a lot more about inflation. Now, Jean-Claude Trichet tells his program that he doesn't see an inflation danger in Europe, but in the US, he says it's different. So up next, we'll go back to the conversation with Stephen Major, and we discuss what the upcoming meeting of the ECB means for forecasts. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In terms of anchoring solidly medium and long-term inflation expectations around 2%, and we will see exactly what will be the conclusion of the policy review that is ongoing. But it seems to me that we are certainly not at a level where inflation would be a danger in Europe. In the US, it's different.
There you go, Mr. Trichet, saying inflation is not a dangerous level in Europe, but in the U.S. it's different. That was the former ECB president speaking exclusively to this program yesterday. Now, Stephen Major of HSBC is still with us. And Stephen, this kind of goes back to the point you were making before, that many people actually think that inflation is going to be dangerous, that it could surprise, and I guess, take maybe the Fed on the back foot, but you think that's just not true, and it's kind of within the range that you're expecting. Is there a danger that actually the market is pricing things that don't happen? So what is the market getting wrong right now?
Yeah, well, actually, listening to Mr. Trichet there, he was the one, I think, who's first coined the transitory language, and that's a long time ago. So now we're finding new ways of saying the same thing because it's getting a bit boring. I think the Fed's looking at other things like employment, and I think that the market looks beyond the near-term releases like inflation, and is looking at longer-term drivers that matter to bond yields. And some of these cannot be controlled or affected at all by what the central banks are doing. And I'm thinking about debt levels and demographics and technology, etc. I think that there's a lot of people getting very excited about inflation, and this has been going on all year and through much of last. And we're seeing bond yields falling the last few months, and it's probably very frustrating for those who are looking for higher yields. But to me, the market is just priced logically to what the Fed is saying, that they're not going to hike rates for many years.
Steve, so where do you find value in bonds right now?
Well, for the government bonds, the best on the Treasury curve, we think, is going to the longer end. I'm talking here about 30-year bonds. If absolutely nothing happens and the market just sits in a range, then you need to be more in the sort of 5 to 7 year part of the curve. But the 30 years where we really like value. But I think in a global portfolio, you have to diversify. So we need to get the right proportion of all the different markets. So, China's done really well this year, and China has outperformed the US by about 10% in dollar terms. I doubt that can be maintained for the second half of the year. But again, it shows the strength of diversification. In Europe, yields have backed up quite a lot, haven't they? And if you think about it, yields for bonds, OATs, and BTPs are in the middle of the range for the last few months. And so they haven't really followed the treasuries back down to the bottom of the range. So the European markets have potential to rally more, but then it all depends on the ECB.
Yeah, what are you expecting from the ECB today? It's going to be, I guess, difficult for Christine Lagarde to strike the right tone.
Yeah, well, they're in the process of a deep think as well. Don't forget. So they're having a good think about everything that they're doing. I don't think any of us are expecting a surprise. So I think they continue this as long as they can. I know that inflation's gone up, and that's probably quite welcome from a Eurozone perspective. It's gone up towards the target. But this is not the right time to be withdrawing the stimulus, and it's very early days in terms of recovery. And I think the ECB is going to signal that, even if they do upgrade their growth forecast for the coming years.
But how should they, should they actually give a more explicit indication of what they'll do with PEP going forward, or is it wrong to have targets?
Well, there's all sorts of things, because we could be creative and speculative about this all at the same time, but there's so many programs and acronyms. And there has been mention of old programs and how these could all be wrapped into the new ones. So with some clever management and creativity, they could create a lot more firepower and buy a lot more time. And that's what it's about. And as you know, there are rules, there are constraints, but the ECB has shown itself to be quite clever with this. And I think it can be stretched out well into the future.
Steve, when you look at forward yields and consensus forecast, and this is something that came out in your note, it's very clear that they're considerably higher than your longer bond yield forecasts. So When are you expecting the market to readjust?
Well, this is interesting, because with the Treasury market, there's a lot of juice in the forwards. What I mean by that is the market is priced for yields on the 10-year part of the curve to be about 60 basis points higher in 2 years' time. Now, that seems to be pretty much lined up to where the consensus forecasts are. So people are forecasting what the forwards are already implying. If nothing happens, that's a lot of carry and roll and prospective return to take out. So from my perspective, if the yield is the same now at year end, so if at year end it's the same as it is now, then that's a winning trade. But I suspect with people trying to position for higher and higher yields, the opposite will happen. The Fed and other central banks are looking through the noise. And just because inflation has gone up a bit doesn't mean to say they're going to change their policy. And that's what really matters to bonds. There's a huge central bank effect on the bond yields. And as the short rate stays down, the bond yield just can't go up.
What's your take? I think you also mentioned Brazil or other emerging markets. Is there any value that you're seeing, again, in something that maybe we don't talk about day in, day out?
Yeah. Well, look, this is the thing. I think investment managers are having to work hard to get that incremental return. You talk about EM, and the high yielders have been not the place to be recently. So here I'm talking about countries like India, for example, and you're right to mention Brazil. It has been one of those, but maybe things are changing a little bit. And on the fiscal side, I think we've got a bit more of a bond positive story. So you'll see that our recommendations have been shifting there. Additionally, we like Russia because we think there's been a lot of front loading of the rate hike expectations. In other markets, like in credit, very difficult to get much value when IG credit spreads are so tight, and you have to go down the credit curve. But we're looking in the US around the single B point. It's looking like it offers a bit of relative value versus a high yield. But people have to work for their returns now, and we're in a lower for longer environment, and that means diversify and look for value opportunities.
Stephen, thank you so much. Stephen Major there, HSBC Global Head of Fixed Income Research. Valuable, extremely valuable insight as always. Now, coming up on the program, we'll be live outside the European Central Bank ahead of today's meeting. Maria today will be watching for any talk about tapering. Plus, the retail-driven targeting of shorted stocks continue with Clover Health and Context Logic gaining again in pre-market. We'll break down the next bout of meme stock mania with Eddie van der Walt. This is Bloomberg.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. The U.S. plans to buy 500 million doses of Pfizer's coronavirus vaccine to share internationally. This comes as President Joe Biden is preparing to join other G7 leaders in a campaign to end the pandemic by distributing jabs worldwide. The G7 leaders are gathering for their summit in Cornwall here in the UK. Meanwhile, President Joe Biden and British Prime Minister Boris Johnson will commit to resuming travel between the two countries as soon as possible. It is not clear how soon that actually will be. The two leaders are meeting ahead of the start of the G7 summit. They will launch a joint task force to explore the different travel options. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thanks so much. Now, coming up, meme stock mania gets a revival. The SEC plans a review of stock trading rules as GameStop announces new leadership. We'll discuss that next with NLive's Eddie van der Veld. We'll also look, of course, at treasuries. And don't forget, ECB Day and Inflation Data Day in the U.S. This is Bloomberg.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America. BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
President Biden arrives in the UK for the G7 Leaders Summit as the world's richest countries vow to deliver 1 billion extra vaccine doses over the next year. Now, the ECB is set to review the pace of its pandemic bond buying program. Treasuries climb ahead of a crucial U.S. CPI print this afternoon. And meme stock mania gets a second lease of life as the SEC plans to review stock trading rules. GameStop reveals a new leadership composed of Amazon veterans. Well, good morning, everyone. Happy Thursday and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the meme stock craze has been well and truly revived with a host of new names now gamering attention among retail traders, from medical insurance to wrestling to prisons. Reddit's targeting a heavily shorted stocks has been winning formula for those who get in early enough, but targets are dwindling as investors get wise to the gambit. Now, U.S. regulators have also called for a broad-based review of stock trading rules. This call from the SEC Chair Gary Gensler coincided with an earnings report from the original meme stock, GameStop. Now, after nearly a 1,500% run-up in the share price this year, the company actually announced new management in the form of 2 Amazon veterans. Well, joining me now is MLive's Eddie van der Walt. Also, Eddie's in person. I can't believe they let us do this in person in the studio.
We're in the same studio.
So, yeah, we're going to go rogue and also talk about Bitcoin. But actually, I mean, the meme stocks are crazy because now it's really opening up like a whole new chapter.
Yep.
And so it's kind of like, you know, alive and kicking.
Yeah, absolutely. I think so. I think, look, there was a great discussion by Joel Weber on the podcast Trillions the other day about, you know, looking for an ETF that gives you exposure to these sorts of things. And I think that's the challenge for investors is staying ahead of what is new. It's a constantly moving target. And just knowing what the, where the Redditors are going to turn next, if you were ahead of that trade, you know, it's a killer.
Okay, what I still don't understand is, are they in it for the money, or are they also in it for a bit of a laugh? Because if it's for a bit of a laugh, then it's difficult to peg an ETF to it.
Right, it is, but I think there are smart ways that people can go about this, right? So you can track social media activity and say, okay, we're going to take exposure relative to how busy, how many times it's mentioned on Twitter and so on. There are ways of doing this. So I think, you know, down the pipeline, we're going to see these sorts of products. But I do think you're right. The investors, for many of them, it's a bit of a laugh. It's entertainment. But they are doing it to get rich, ultimately, right? It's not just, they're not just throwing money at this. This is not just the new entertainment. It is a way for them to seek exposure and to tap into the zeitgeist.
I mean, we actually also thought about a new coin that we could, for a bit of a laugh, put in place, but that's another story. So the SEC is now looking at actually these, you know, new possible rules for stocks.
Right.
And this is basically as a reaction to what we're seeing on Reddit and retail traders. How far will they go?
Yeah, I mean, they're constantly playing catch up, right? And this is the problem, is that there are new forms of communication, there are new asset classes out there, and the regulators are always, you know, a step behind, as it were. So I think in the fast-moving environment that we are in today, I just don't see the SEC being on top of things in such a way that they can really tamp this down.
But so what are they trying to do? If you're an SEC regulator, your main concern is that actually something goes bust and everybody loses money and it's all life savings, or are they looking at it from another angle?
I don't think that is the main concern. I think if you're willing to speculate, you are willing to lose money, right? I think what they're trying to quash is insiders trying to move the market, buying stocks ahead of time, and I think, you know, that's classical. But these problems have been with us, you know, as far back, as stock markets have been with us. If you look at, the bucket shops of old, it has always been there that there would be insiders that try and build up liquidity to try and pull in new investors. It's a difficult thing for the SEC to do.
Let's also talk about cryptocurrencies, because I always want to talk to you about cryptocurrencies. Bitcoin regained some ground after slumping below $33,000, but after the high-profile ransomware attack on Colonial Pipeline, which took payment in Bitcoin, the regulatory scrutiny on the asset class is getting more attention than its price swings. Now, the interview for me of the week, without a doubt, was Senator Elizabeth Warren telling our Joe Weisenthal that more needed to be done by Congress.
banks either holding Bitcoin, that becomes an issue that we need to talk about with the bank regulators. So there are a lot of different pieces to this, and I think the answer that we saw today is that right now our regulators and frankly our Congress is an hour late and a dollar short, and we need to catch up with where these cryptocurrencies are going.
The primary driver behind ransomware attacks isn't the existence of cryptocurrency. There have always been malware attacks. There have always been different types of attacks against organizations that steal intellectual property, that steal client data, that steal financial information, or even steal funds. There have been lots of compromises of financial institutions over the years. I think this really just highlights how important the security and how vulnerable many organizations are, and they really just don't have their house in order when it comes to security.
Okay, so a kind of attack and then the response from the Bitcoin believers. So let's get someone who's right in the middle. Eddie van der Veld is still with us. Eddie, I mean, I thought it was pretty extraordinary, actually, because she's right that, I mean, first of all, how many people in Congress and amongst regulators understand what we're dealing with?
And I think this is a very different asset class, right? I think tamping down on on investment and speculation in equities is one thing, because this is an asset class that has something underlying that has been there for a long, long time. In cryptocurrencies, I think the regulators have been extremely hands-off because they wanted the space to grow. But ultimately, there has been a lot more wrongdoing in this space over time, and I think this is something that they will probably be a little bit more hands-on. They don't know exactly how they're going to do it yet, but I think there's a growing appetite for saying, okay, well, hang on a second, enough's enough. We've got to bring things under control here.
So, I mean, by wrongdoing, you mean the lack of transparency, but then you can also track what Colonial Pipeline and the hack taught us is that actually you can definitely track these transactions. I think it's from the hackers that we've seen. I think, but it's also just coins that have been launched and then bought by insiders, then pumped and dumped. So I think there's been, I mean, these kind of schemes we got rid of in equities for a long, long time ago. We said, look, you cannot do that. But now we're seeing this emerging cryptocurrencies, and regulation hasn't caught up with the cryptocurrency space, and there's a lot more to do. And I think the regulators are probably going to focus more on this space than they are going to on equities going forward. Eddie, thank you so much. I'm looking forward to our catch-up also a little bit later. Eddie van der Veld from MLive, of course, looking at everything from these meme stocks or stonks to crypto. Coming up, ECB officials seem unlikely to spring any surprises over stimulus at today's meeting. We're live in Frankfurt next. This is Bloomberg.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacquet here in London. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gearns. Hi, Leanne.
Hi, Francine. Bloomberg has learned that United Airlines is in advanced talks to buy at least 100 Boeing 737 MAX jetliners. It would be part of a broader fleet revamp. United sees it as a chance to upgrade at a time when Boeing and Airbus are hungry for deals. Now, Facebook says it will let all employees work remotely even after the pandemic if their jobs can be done from home. But the world's largest social network said it may reduce workers' pay if they move to a less expensive area. Facebook plans to open their U.S. offices to 50% capacity by September. And Keystone Pipeline, a symbol to oil's friend and foes, is now dead. TC Energy has ended its 16-year quest to build the cross-border project that became a litmus test for climate activism and ended up blocked by President Joe Biden. In a statement, the Calgary-based company said it ended the project after consulting with the Canadian government. And that's your Bloomberg Business Flash. Francine.
Leanne, thanks so much. Now, of course, it's ECB decision day, and officials will decide how much monetary stimulus the Eurozone needs as it emerges from lockdowns. From ramping up their bond buying program in the second quarter to keep borrowing costs in check, it's time for officials to settle on a new pace for the months ahead. Now, the central bank is also due to update its economic projections. So let's get more on all of this with our very own Maria Tadeo, who joins us now live from Frankfurt. Maria, can President Lagarde walk the line between an improved outlook while avoiding taper talk?
Yes, Francine, and really that is the question going into this meeting today. We know that on paper, the policy action is not going to change. So this is very much about the language from Christine Lagarde. On paper, as you say, there will be an improved outlook for the European economy. We're probably going to get a revision for both GDP and inflation expectations. Of course, the picture, when you look at the previous projections, they came out in March, and it was a very different situation for the European economy. We're still very much in lockdown. There were still a lot of restrictions, and coronavirus was still rampant in the EU. Now we're looking at an economy that is gaining momentum, especially in the second half of the year. And of course, we have seen that uptick in inflation. There's a big debate as to whether this is just a one-off or something more fundamental. So I have to say, Francine, a lot of the investors and some of the analysts that I've been speaking with this morning, they say the focus and the attention will be on the PEP program and that line on keeping the purchases significantly higher. Some of them have told me if that word significantly does not feature in today's press conference, then you could see a sell-off in some of those European assets precisely because the market right now is not positioned for anything that looks like tapering.
Maria, in terms of the strategic review, so we're also expecting this three-day retreat from the ECB to reinvigorate the debate. What can we expect?
Yeah, Francina, I would really love to be a fly on the wall there for that three-day retreat. And this is going back to the strategic review that the ECB had embarked on. A lot of this was suspended in 2020 because of the pandemic, and the focus really changed into just dealing with the economy. But that debate is back on track. And the big focus, of course, is inflation. How to measure inflation, what should be included into measuring that benchmark, but also the number, the figure that you should put into there. And also, Francine, in many of the conversations that you've had with Christine Lagarde, she's also highlighted this idea of climate and how to incorporate that in the European Central Bank's mandate and how that features in the economy going forward.
Maria, thank you so much. Great work out there. Maria Tadeo there in Frankfurt for us. Now, joining us to talk about the ECB is Silvia Ardagna, Barclays Head of European Economics Research. Silvia, thank you for joining us. It's a big day as we wait to see how President Lagarde actually navigates, maybe better than expected economy whilst not talking about tapering. What are you expecting from her?
Good morning. Thank you for having me here. We expect no change to the policy stance, obviously not to the interest rates, but not even to the asset purchases program. So we have said that we expect the pace of purchases to be maintained at the Q2 average. This still leaves the ECB with some flexibility. We know that they have bought about 80 billion per month in Q2 so far, but obviously June is still to come. So we don't expect much in terms of monetary policy decision. The action will be also on the forecast changes. And here we also believe that there will be a sizable upgrade to the 2022 growth forecast. This in part to reflect the fact that there is a bigger carryover from a strong H2 this year, but also because we think the ECB will upgrade the assumption on fiscal policies. Remember that the ECB has still to incorporate the impact of the US stimulus package that was passed in March, and they estimate it to be worth about 30 basis points over 2 years. But also it is likely that the assumption on euro area fiscal policies are going to be upgraded, both because the stability program countries submitted to the European Commission show that there is more fiscal, but also because the Commission gave upbeat forecast of the NGU funds.
So, Silvia, overall, what are you hearing, or what should we be hearing from PEP? Is this maybe the only thing that the ECB could actually give us more of a guidance of what they plan to do with it, or are you expecting not much on that front today?
So we don't expect much on guidance beyond Q3, and this is because, as you said just before, the strategy review is about to be completed, and so we expect more action relative to forward guidance in terms of asset purchases in the September meeting. But clearly through the forecast, right, we will have a sense that the outlook is very much improved. We also think the ECB will try to stress that the acceleration of inflation this year is going to be a one-off temporary phenomenon. And so they will look through it for now. But again, when it comes to the pace of purchases for Q4, it is likely that maybe the ECB will reflect later on in time the improved forecast.
Silvia, what is the Eurozone's biggest challenge at the moment? So if you look at the Fed, I guess it's inflation, but the ECB has another set of problems.
Yeah, I think the main challenge that we see is the fact that the recovery is starting, but it looks like to be a divergent recovery across different areas and different sectors and countries. And it is important to avoid or limit what could be long-term scarring effects from the pandemic. When we look at the labor market, we say there is more slack than meet the eye if you just look at the unemployment rate. Keep in mind that there has been a sizable decline in hours worked and that labor force participation has also dropped. So as economies pick up and as government gradually scale down fiscal policy, some of the workers on furloughs might lose their jobs and jobs might not be created at the same speed at which new people join the labor force. So there is going to be a period of transition in which we need to be watching for scarring effects and how deep these are going to be.
Sylvia, and the other big story, of course, is what's happening between the UK and the EU. The fact that on this Northern Ireland protocol, things are just not getting better, and it seems that we're also talking about tariffs and potential quotas. How does that play out into your economic forecasts? Is it for the moment, noise or scaremongering, or could it actually have a deep, long-lasting impact?
Yeah, we have not really, focused on this. It's not something, we basically have all the new trade relationship between the UK and the EU, backed in obviously in our forecast from both sides of, from both country sides, but nothing of what we are hearing, these days have changed our outlook both for the euro area or the UK.
Silvia, as always, thank you so much for joining us. Silvia Ardagna, there, Barclays Head of European Economic Research. Coming up, Credit Suisse loses a trio of senior bankers. Bloomberg learns that the lender is planning retention bonuses to keep senior staff on the payroll. That scoop is up next, and this is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there has been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada is going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Europe's financial sector has made some progress with minority and female inclusion, but any momentum has slowed in the wake of COVID-19. I'm Francine Lacqua, and we'll take a look at the pandemic's unequal impact on financial services. We'll delve into the data and some of the reasons behind the drastic drop of women in the workforce. We'll also get the views of two very senior women in the industry on creating an inclusive environment, retaining talent, and the future of work. All in our latest Money and Equality special this weekend on Bloomberg Television.
This is a market that, over the past few weeks, has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, a trio of senior Credit Suisse bankers have left the firm. It's the latest in a string of exits following the lender's recent debacles with Archegos and Greensill. Andrew Conway, Charles Hadid, and Marco Staccioli are moving on to Bank of America, Morgan Stanley, and Jefferies, respectively. Bloomberg has also learned that Credit Suisse is set to offer retention bonuses to top bankers to stem the flow of senior departures. Well, joining us now for more on this is one of the reporters to break that story, our finance reporter in Zurich. He's Patrick Winters. Patrick, great to have you on a great scoop. What is the potential size and scale of these retention bonuses?
Hi there. So it's a difficult one to work out, and while we've had some indications, it's not something which we're ready to publish yet. But you can definitely think about these guys. These are the top revenue generators. Within the investment bank who are leaving. And what Credit Suisse is doing is trying to protect its revenue base. These are senior guys in the US. These are guys with responsibility for transactions. So you can imagine these are people who are earning $500,000 a year minimum. Many of them more than $1 million, and they can take their business elsewhere. So Credit Suisse is eager to give these guys some assurances that they will be taken care of. But what Credit Suisse is doing is also about reputation, because at the moment they're a bit like the kid at school who's being picked on, with the American banks picking away their most senior people. So they have to show that Credit Suisse is a place where people should be proud to work and where they also get paid competitively.
So will it be enough, I guess, to stem, people leaving, or are other banks also doing the same, in increasing bonuses to make sure that they attract top talent?
So one key thing about this point in time is that Credit Suisse is in a very difficult situation. They've had these twin disasters of Greensill and Archegos, which have really torpedoed their profit in the first quarter. It's also seeping into the second quarter. Meanwhile, it's been an amazing start to the year for most investment banks. There's good trading numbers, and at the same time, lots of deal-making activity, lots of IPOs. So this should be a point in time where bankers are being paid the most. This is almost a peak in payment and bonuses for them. So it's not a time where you can afford to not pay them right, because given this kind of cutthroat industry, they'll just take their business elsewhere. So I think Credit Suisse will definitely be giving some kind of assurance, whether they're paying large quantities of cash now. Difficult to say.
Who, Patrick, is more in demand? Is it junior bankers, like we saw, for example, at UBS, for these retention bonuses, or is it top bankers?
I think right now what Credit Suisse is trying to do is stop the defections of top bankers. When they look at it over the next 5 or 10 years, though, it's also a point about keeping juniors, but that's not just related to Credit Suisse. I think that's also an industry topic where they want to keep these analysts who are sometimes working 60, 80 or 100-hour weeks interested in working in banking and not moving on to tech industry or somewhere else.
Patrick, thank you so much. As always, Patrick Winters there, our finance reporter in Zurich. Now, let's also look at the markets. A lot of the focus, of course, is on treasuries and the rally that we saw yesterday. This comes on the back of, a little bit later, we'll have some inflation figures, CPI from the U.S. It's also ECB day. So before the inflation print and the ECB, things look pretty stable. That could change. It's very clear that if you look at, the U.S.-China talks going a little bit better or in the right direction, it certainly helped with sentiment, and they also bolstered offshore yuan. Plenty more of Bloomberg Surveillance Early Edition is up next with Matt and Kaylee. This is Bloomberg.
We've sadly lost 12,000 premises across the sector as a whole. We lost about 330,000 additional staff in terms of headcount through the pandemic. It is a gradual road to recovery, but I am feeling much more optimistic. The positive response we've seen from consumers in returning to eating and drinking out, even outside, has been very welcome. And of course, we're not out of the woods yet, because we know that about 20% will struggle to reopen with social distancing restrictions, and every day that they are closed makes it less likely that they'll be able to reopen. So I think you will see continued business failures within hospitality over the course of the next year. Well, I think the government support has been unprecedented. Equally unprecedented is the hit that hospitality has taken. So we do need the government to look at a solution on rents. which is going to be critical to recovery, a recapitalization strategy to tackle the levels of debt that these businesses are going to come out of the pandemic with. So this government support, fantastic, has allowed us to maintain a large number of staff that we would have undoubtedly lost along the way had we not had furlough. But furlough actually is costing the businesses to implement at the moment, and the costs of staying closed, the industry is burning through £500 million a month in ongoing costs.
The power of Bloomberg. First on news.
Headlines crossing from Morgan Stanley to management shake-up, planning for transition in 3 years potentially.
This is a huge move over at JP Morgan. It is a shock, of course, to the market.
First on earnings.
Apple, a big beat, well ahead of the 33% increase in revenue.
First on markets.
The capitulation phase is by.
The power of the Bloomberg terminal. The power of Bloomberg television and radio. Bloomberg has it covered.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
We are watchful because we have never experienced in the past a recession that was self-inflicted.
It's not like nothing is getting done. But on really big issues out there, like on coronavirus response, like on climate change, we are very, very far from meaningful global coordination.
The United States has a responsibility, a moral responsibility, to help people get out of the pandemic and the vaccines. But there's a leadership in the global economy that frankly starts at home.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua, Matt Miller, and Keely Lines.
Well, good morning from London, Berlin, and New York on this Thursday, June the 10th. Our top stories today. Biden's ambitious agenda at his first G7 summit. The president is pushing plans to vaccinate millions around the globe and to reopen travel between the U.S. and the UK. The ECB plots its next move. Central bank officials will decide today just how monetary stimulus the Eurozone needs to return to normal. And new reason to worry. Today's CPI numbers may show whether higher inflation in the U.S. is here to stay. I have to say, there are a number of stories, Kaylee. I was looking at President Biden's agenda. It does seem packed. They could touch on Northern Ireland or not, but it's very clear that the market will get impetus from ECB and then U.S. inflation data.
Yeah, the G7, Biden's meeting with UK Prime Minister Boris Johnson, plus the ECB, plus CPI. Not a busy day at all, Francine, but here's how we're shaking out in the markets ahead of that. In the Asian session overnight, most stocks were higher. The Hang Seng was essentially flat, but the Kospi and the Nikkei did close in the green. And your outperformance actually came from China, with the CSI 300 up about 0.7%. Of course, that is after news overnight that the U.S. Commerce Secretary and Chinese Commerce Minister held their first call under the Biden administration, pledging to continue to push for trade and investment ties. The Chinese yuan was stronger against the dollar substantially after that news. It has given back some of those gains, though right now we're sitting at 638 or so. Of course, it is mostly a stronger Asia-Pacific currencies against the U.S. dollar today, including the Japanese yen, which is sitting around 109.48. Here in the U.S., of course, we are awaiting that inflation data at 8:30 a.m. Eastern time. And ahead of that, we're sitting just shy of record highs. S&P 500 futures right now up less than 2 points. We're sitting right around that 42.10 level. In the bond market, of course, we did see that rally yesterday. A lot of that may have been due to short positions unwinding. And this morning, we are holding below that 1.5% level on the 10-year Treasury. Does not look like a market that is concerned about inflation. Elsewhere, I would point that oil is just below $70 a barrel on WTI, and we are seeing a continued tick up for Bitcoin, though it is off session highs right now, essentially flat, right around that $36,000 level, Matt.
All right, we'll be watching that closely, but it does seem to be holding relatively steady around this level. the drop that we saw earlier in the week notwithstanding. Let's take a look at what's going on in European markets right now. We have equity indexes that are down across the continent or down very little. That's the gray that you see on the map there. With the exception of the UK, it's a gainer. The FTSE up ahead of most other indexes. Take a look at the Stock 600, the broader European benchmark index, and you'll see it is, well, do I not have the Stock 600? No, I've just got the FTSE here, interestingly enough. But the FTSE is up, the Stock 600 is down. That was going to be my point. The 10-year German Bund right now at 24 basis points to the negative. We'll be watching that very closely as the ECB comes out a little bit later. And, of course, you can see the euro right now trading at 121.66. So hovering around its recent highs, not quite up to the 5-year high at 125, which may make the ECB a little bit more nervous. And I put the pound in there. You know, there was a report, Francine, in a British newspaper earlier that said the U.S. was going to issue a diplomatic rebuke of the UK's behavior around Northern Ireland. Now we're hearing from an official that there will not be a diplomatic rebuke. They're still unhappy about the way Boris Johnson is handling Northern Ireland, but they're not going to officially chide him, according to this official.
Yeah, I have to say that would have been, frankly, pretty punchy. And at the same time, once it's leaked, it's almost like you were rebuked, even if it's not official. Now, let's look at what else is coming up today at 7:45 a.m. New York time. We'll get the latest ECB rate decision, followed by a press conference from President Christine Lagarde. Then also at 8:30 a.m. U.S. time, we'll get U.S. May CPI and jobless claims. Iran nuclear talks reconvene today in Vienna. And finally, the U.S. President Biden with the U.K. Prime Minister Boris Johnson will hold this bilateral meeting today ahead of the G7. As Matt was saying, we're no longer expecting a rebuke over Northern Ireland or the Irish Protocol, but they will be discussing ending the bitter standoff over, of course, actually they'll be discussing resuming travel between the U.S. and the UK. Now, our Guy Johnson enjoying the Cornish weather over in Cornwall, where the G7 is meeting. Guy, what exactly will they talk about? So we're not expecting an official rebuke, but a lot of the talk will be, of course, on COVID vaccinations.
Yeah, I think that's going to be one of the big themes that comes out of this meeting is, and we've seen this in the communique, which has already been leaked, we are going to see a plan basically to try and vaccinate the world. This fulfills a number of different objectives. It basically gives the G7 a humanitarian role. It allows the G7 also to push forward with its agenda rather than letting China step into that void and help vaccinate the world. It also deals with the issue of many poorer countries saying, well, if you can't help us vaccinate, why should we sign up to your climate
Good morning, traders. Are you ready to trade Bitcoin? I'm going to place an order. This time I'm going to sell short. So I want to sell short Bitcoin. The price I'm looking to sell short, 36,752. If you're looking to sell Bitcoin and if you're looking to trade Bitcoin, this is the price. So all of our customers, if you're using the strategy, if you're following our trades, it's time to place order for Bitcoin. It's 36,752. Okay, stay with me, follow my trade, and we will make a profit on this pair. That's Bitcoin against United States dollar. Okay, stay safe. And I'll speak to you later.
In that effort.
Well, I think this is a really interesting paradox that we currently face at the moment, Kaylee. At one level, clearly, the US wants to push back against China. It wants to push back against autocracies. It wants this club of democracies. But when it comes to trade, when it comes particularly as well to climate, how do you marry these two things together? And I think that's going to be the real challenge here at the moment. How do you, for instance, on climate, so you say on one hand, look, we're not happy with what you're doing. We're not happy the way we're dealing with Hong Kong, the way you're dealing with the Uyghurs. We're not happy with all of that, yet at the same time, we want you on board with our climate pledge. I think the idea is you have this kind of overwhelming global force when it comes to signing up for climate pledges that China simply cannot ignore.
Guy Johnson, thanks very much for reporting live from Cornwall. Let's turn now to the ECB. We'll get a policy decision, economic forecast, and a press conference from President Lagarde later today. In focus, the scale and pace of the bond buying program. Joining us from Frankfurt is Bloomberg's Maria Tadeo. So, Maria, can Lagarde walk the line between an improved outlook and avoiding taper talk?
Well, Matt, really, that is the core of today's meeting. We know that on the policy front, not a lot is going to change, but that press conference will be interesting, especially because we're going to get new economic projections that will paint a more optimistic picture of the European economy. We're likely to get a revision to both GDP and inflation. The dynamics in the European economy have really changed from March when the first initial forecast was put out. This was the height of the pandemic. This was a lot of restrictions and Europe closing. Now we're looking at an economy that is gaining momentum. Now, the market is not positioned for anything that looks like tapering. Christine Lagarde herself has said that any discussion about tapering is now premature. But as you mentioned, there will be a very strong focus on the language around the PEP program. In particular, this one line that says significantly higher pace of purchases in the PEP program. You know, a lot of the sources and people I've been speaking with this morning, they do say that if that language gets changed, that word significantly is not featured there, you're going to be very much going to be getting a sell-off after the meeting. So again, it's a very tricky communications task that Christine Lagarde has today.
Maria, what are we expecting in the strategic review?
Yes, and Francine, you know, a lot of the ECB watchers actually tell you that this is the thing that really matters. To some extent, it is a battle for the soul of the future European Central Bank. A lot of the debate focuses, as you can imagine, on inflation. You know, that target close but below 2%, but also the way that you measure inflation. You know, I hear many economists who now say housing costs, for example, that should be included in it and it should be measured differently. There's also a new element coming into play. You know, in all of your interviews with Christine Lagarde, she always highlights this idea of climate and climate risk and how this needs to be incorporated. So it'll be interesting to see how that debate is injected into new life now that the worst of the pandemic does seem to be over in Europe.
All right, Bloomberg's Maria Tadeo reporting from Frankfurt with just about 2 hours and 35 minutes or so to go until that ECB decision. Now, I do want to take a quick check on some stocks moving in pre-market trading here in the U.S., one of them being GameStop. It, of course, reported results after the bell yesterday, did tap two Amazon veterans to be CEO and CFO, but the company also announced a share sale of as much as 5 million shares and said the SEC is investigating trading of its stock. That investors don't like so much. The stock down about 8% in early hours. And of course, GameStop is the OG for the meme stocks, but there's a new batch of them that are now at the forefront, one of them being Context Logic. The shares did fall yesterday. This morning, though, they're up about 4%. One stock that rose substantially yesterday in this new wave of meme equities was Geo, the private prison operator. Shares were up 38% in yesterday's session. Today, though, they're down about 8.5%. So it's a bit of a mixed picture when it comes to those meme stocks this morning, Francine.
Yeah, I know we'll talk a lot more about these meme stocks throughout the day. Coming up, Seema Shah, Principal Global Investors Chief Strategist. We have a lot to talk to her about. Inflation, ECB, and maybe we'll touch on some of the retail traders and the possible new rules on U.S. stocks. And then later this hour, Randy Krosner, a professor at the University of Chicago Booth School and former Fed governor. This is Bloomberg.
enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in Berlin with Francine Lacroix in London and Kaylee Lines in New York. Now, in our Taking Stock column today, we focus on CapEx. Spending is back with the reopening trade. It looks like companies are now choosing to invest or expand more often than they're choosing to give money back to shareholders in the form of dividend. I've got a great chart that you can see. I stole it from Michael Msika, who wrote this Taking Stock column today. And for our listeners on radio, we welcome you as we do every day. I'll just point out that what this shows is the Barclays Europe CapEx beneficiaries, that's the white line up here, is outperforming the S&P 350 Dividend Aristocrats Index. So if you invested in companies that benefit from CapEx, you're doing better than if you're relying solely on dividend plays. Joining us to talk a little about this and much more is Seema Shah, Principal Global Investors Chief Strategist. Seema, what this says to me is that the reopening play is alive not only for investors, but also for executives.
Yeah, and I think we've been seeing evidence of that across most of European activity. And this is a really big change from where we were 3 months ago. So many concerns back then, but really the tide has kind of shifted for Europe. It's really promising to see that CapEx is moving forward. A lot of people have concerns about, what happens post that reopening bounce. This is a promising view to kind of post those next 3 months as well.
What is the one thing, Seema, when you look at all the inflation expectations, if we have a big print on inflation today, is it already priced into the markets?
I think to some extent the market has moved on from thinking about the level, right? They know that there's a fair risk that things are going to be higher than expected. CPI will be higher than what was anticipated just 3 or 4 months ago. The concern now is just how sticky that inflation is. Now, unfortunately, it's going to be very, very difficult to have an idea of how sticky it will be for several more months. And I think that's one of the reasons why we've actually seen markets be pretty much range-bound over the last couple of weeks. They know that it's still some time to go before they get that very key question answered.
But so, Seema, where do you see the best value? What are you buying right now, given the uncertainty and the fact that we still have to wait a couple of months to exactly know the full picture of what's going on?
Yeah, so I mean, I think there's a couple of themes at the moment. So I think on the inflation side, even if, there's a lot of people out there, including ourselves, who believe it will be transitory. But even if you believe it to be transitory, you still have to take note of the inflation risk out there currently. So there needs to be some kind of portfolio protection. We like real estate, particularly data centers. That's kind of playing on the technology, the reopening trade, as well as trying to think about inflation. But increasingly, from a regional perspective, Europe, it's really showing all the right signs for now. The reopening trade is back on. We have European inflation probably lagging behind US inflation, which certainly suggests ECB dovishness lasting longer than the Fed. So there's a couple of things all moving in the right place, in the right direction for Europe as well.
So does that mean you're no longer underweight Europe, Seema? You have been against consensus for some time.
Yes, exactly. So we have moved to an overweight position for Europe. There's a number of reasons. Originally we were quite hesitant about how successful Europe would be with regards to the vaccine campaign. Clearly, they're doing very, very well, and reopening is underway. The momentum is picking up with activity. On inflation, it's kind of lagging behind the US, as I said. And of course, if you believe in the value trade at the moment with the steeper yield curve, Europe is the place to be playing that trade.
Do you think we can break out of this range anytime soon? Obviously, the Stock 600 has just been inching record after record, but we're looking at very marginal moves. What makes us move substantially higher, in your view?
Well, as I said, I do think for the next couple of months it's going to be range bound, but also really quite vulnerable to any major disappointments, right? So we have everything on a standstill, waiting to see how the inflation story goes, waiting to see how central banks are going to react. So that communication from the various central banks has got the potential to shift one way or the other. But I think for us, the baseline scenario is that, this is going to be your typical summer lull, with, of course, that vulnerability given, given the slower liquidity that you typically get this time of year. Come fall, I think, will be very different.
We haven't seen a lull for the meme stock, Seema. I got to get your take on this, although I know, it seems to be something maybe trivial, maybe a fad, but it just doesn't stop. Is investing changed?
Look, it is just really, really interesting. It's fascinating for all of us to watch. Does it change the way that we trade and the way that we're looking at the various stocks? No, not really. We're still very much believers in that fundamental analysis. A lot of these meme stocks, we should expect volatility. There's investors looking for quick gains. So, it's probably not something that to be looking at if you're a medium to longer term investor. This is very much day trading, kind of very, very short perspectives, which is certainly not our approach.
All right, Seema, thanks so much. Seema Shah, their Principal Global Investors Chief Strategist. Now, later on, Bloomberg Surveillance, a conversation on the return of travel with the International Airlines Group Chief Executive Officer. He's Luis Gallego Martin. It'll be interesting to get his take on President Biden meeting with the Prime Minister of the UK and whether travel between the UK and the US will be much easier in the future. That interview is 6:30 a.m. in New York, 11:30 a.m. in London, and this is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
World leaders meet. On the agenda, global tax, security, climate change. Tune in for extensive coverage from the G7 summit in Cornwall, England, and the NATO summit in Brussels. Live on Bloomberg Television and Radio.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance Early Edition. I'm Francine Lachman in London, Matt Miller in Berlin, Katie Lyons in New York. Now let's get straight to the Bloomberg. First word news, and the U.S. and China have agreed to push forward trade and investment links. Now that came out of the first call between commerce ministers from the two countries since the start of the Biden administration. It's still not publicly clear what the U.S. plans to do with the Phase 1 trade deal signed last year or tariffs on Chinese goods. Republican Mitt Romney and a handful of other Republican and Democratic senators are coming up with their own infrastructure plan. But they're moving forwards without any of the tax hikes that President Biden has demanded to pay for the spending. Now, Romney says tax increases are a red line for the group, but he would not say how the plan would be funded. And President Biden and British Prime Minister Boris Johnson will commit today to resume travel between the two countries as soon as possible. It's not clear how soon that really will be. The two leaders are meeting ahead of the start of the G7 summit. They'll launch a joint task force to explore travel options. And Brooks Brothers is going casual. The New York-based chain that has been dressing business people for 200 years is coming to grips with the new normal. Now, even before the pandemic, shoppers' tastes were moving away from suits and towards more casual clothes. Brooks Brothers is plotting to relaunch after exiting bankruptcy last year. Now, it involves a new athleisure line and a product mix with other casual items. I have to say, our Matt Miller is absolutely up in arms about it. And I had you down as a more casual athleisure wearer, Matt. So you've confused me.
No, it's heartbreaking. I have to tell you something. This tie, I stole this from my dad's closet for my 8th grade graduation from the Columbus Academy. This is what Brooks Brothers quality meant. You know, it's a family tradition. It's an American tradition. And going into yoga pants just doesn't make a lot of sense to me for this brand.
But no one's going to be back in the office in as formal a setting post-pandemic, right? Or at least that's the idea, that we're not all going to need suit and ties, except for maybe Matt Miller because he's on television every day. But, you know, got to move forward.
I mean, booted with Savile Row.
Yeah, that's the idea for sure, Kaylee. Everyone's working from home. You don't need to wear a suit. But then, you know, hunker down. Stick to your knitting is what I say. Stick to the golden fleece, not Henry the sheep.
Yeah, I mean, tough when you've just come back from bankruptcy. Coming up, Randy Krosner, professor at the University of Chicago Booth School and former Fed governor. We talk inflation. This is Bloomberg.
Announcing a project and doing a project is something different. And that's why we are so proud. We have started now the first one here. It's running, and I believe that we will see scalability. have now a base to show use cases. So we can develop new cases on how to build a hydrogen economy.
I think what we're seeing during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
This is Bloomberg Surveillance Early Edition. I'm Francine Lachman, London, Matt Miller in Berlin, Kaylee Lyons in New York. Matt, ECB and inflation, that will keep the markets occupied. And then we look at the SEC with yesterday, the fact that they're looking at possible new rules for U.S. stocks.
You know, that is actually a huge story among our clients.
Yeah.
I got a lot of feedback yesterday when those headlines came out from Gensler. I think a lot of brokerages would like to see something changed here. A lot of dealers would like to see something changed. In terms of the ECB, what I think is really interesting, Francine, is, you know, the U.S. clearly wants to overshoot, but the ECB so far has said their inflation target is as close to 2% as they can get, but below it. And it seems incongruous with the Fed message. Maybe that'll change today.
Yeah, and I think there's been, I mean, I've been reading quite a lot of notes from some of the big banks saying, look, the problem for the ECB is not really inflation. They have other, you know, fish to fry, also given the amount of stimulus that they're pumping into the economy. So it'll be interesting, Kaylee, to see how all of that is playing out in the markets.
Well, how it's playing out in the markets, Francine, is we're not going a whole lot of anywhere. The market, of course, awaiting that ECB decision at 7:45 a.m. Eastern time, and then that CPI data at 8:30 a.m. Eastern time. So we're looking at very small moves right now. The stock 600 is lower, falling from a record high, but only down about 0.1%. And I went back and checked. The last time we got a move of more than 0.7% on the stock 600 was on May 21st. So this is now the 15th consecutive day of a move smaller than that. Of course, we are looking at going nowhere on S&P 500 futures at the moment. We're up just about 0.25 point. Again, we're all just awaiting that inflation data. The bond market, though, does not seem too worried about inflation. We are steady on the 10-year yield at that sub 1.5% level.
Oh, yeah.
And the dollar unchanged. So again, there's just not a lot going on. Where there's more going on, though, is at some of the individual movers, those meme stocks, and it's a bit of a mixed bag today. You have some Clover Health, Context Logic higher. They're up 6.6, 4.1 or so percent respectively. But two of the others, the OGs, AMC and GameStop, are both lower. Of course, GameStop down now about 7% after its results after the bell last night. What investors didn't like in those numbers are really more about the company's commentary, a share sale, and then the SEC looking into the trading of that stock, Matt.
You know, Kaylee, you called it yesterday on the 10-year yield when it was above 150. You said it was headed down. I think you have a future at a macro hedge fund. I would invest with you in. Yeah, well, or yeah, you're a clairvoyant. I've got a chart that shows what happened yesterday and what's happening now with the 10-year yield. For our listeners on London DAB Digital, I'll walk you through this. It is the 10-year yield, and what you can see is a candle chart here coming down through some key levels. This is the prescient call that Kaylee made yesterday, but it's really interesting if you believe inflation is going to tick up and here to stay. You know, if the Fed has to get more hawkish, why on earth would you be in there buying more bonds? And it looks like, Francine, that's what investors are doing.
Yeah, it's certainly what investors are doing, Matt. And it's, I mean, it's one of the stories that will run and will keep us, you know, occupied for weeks and months.
Yeah, well, another thing that's going to keep us occupied is it looks like the meme stock trade, it couldn't be further from following Treasury levels, could it? But GameStop is warning of an SEC probe. Wall Street's top regulator is calling for a broad-based review of stock trading rules, including looking into the trading of the original meme stock. So these are sort of two separate things. One is an announcement from GameStop. The other is an announcement from Gary Gensler. In any case, they both touch this world of meme stocks. Let's get to Bloomberg's MLive editor Eddie Vanderwalt for a little bit of a look into what's happening here. Eddie, it's pretty amazing that this continues to happen. We talked to Seema Shah earlier. She said if you're a midterm to long-term investor, you don't need to deal with this. But day traders definitely can no longer ignore it.
Yeah, and you know what? I mean, it has an impact on the wider market as well, because, you know, I don't think because it plays in on the factors. I mean, you know, some of these are value stocks, and they have done particularly well, and that's helped to change the overall fate of value investing in the last few months. So I think this is it's a really interesting story, and I don't think that, you know, even long-term investors can really ignore what's going on in these stocks.
Eddie, I mean, what kind of rules could we actually see in place? Like, how much of a game changer is this? Or is this, once again, a regulator just trying to play catch-up?
Yeah, I think that regulators are playing catch-up. But I think, you know what, really, a lot of the rules are already in place. It's just a case that they have to be enforced in a new forum, right? There are restrictions on what you can say if you are an investor, if you have insider information on stocks. And, you know, so I think there are rules already in place. A lot of it's not being enforced. But at the moment, you know, we are seeing new venues, and it is quicker, and it is anonymous. It's very much easier to move stocks without people knowing who you are. And I think for those reasons, you know, the SEC is struggling a little bit.
Eddie, I want to turn to the world of cryptocurrencies now because, of course, Democratic Senator Elizabeth Warren was on Bloomberg television yesterday and told our Joe Weisenthal that the market for digital coins is the Wild West and said that more regulation is needed to protect consumers from scams. Just take a listen to what she said.
Banks either holding Bitcoin, that becomes an issue that we need to talk about with the bank regulators. So there are a lot of different pieces to this, and I think the answer that we saw today is that right now our regulators and frankly our Congress is an hour late and a dollar short, and we need to catch up with where these cryptocurrencies are going.
So I guess my question, Eddie, is Bitcoin at $36,000 properly pricing in regulatory risk, not just in the U.S., but really globally?
Yeah, I don't think it is. And I mean, that's an absolutely great quote. You know, hour late and a dollar short. I think that's exactly right. The regulators are really playing catch up. And this is a space where they will have to pay more attention because there is really no regulation. This is the complete opposite of the story we were just talking about in stocks, where the regulation is already in place. This is asset classes. We've seen all of this before. It's just a new forum. This is completely different because it's a different kind of asset class. It is things that we don't know yet. It's, you know, it's a whole new venue. So therefore, regulation may have to be a little bit more hands-on and maybe a little bit more hands-on in how they classify these things, because cryptocurrencies is not a unified bunch.
You know what's interesting? Well, first of all, she says Wild West like it's a bad thing. My dream is the Wild West. Eddie, Joe Weisenthal the other day was pointing out, you know, Bitcoin can't be a crypto, or can't be a currency, I should say, cryptocurrency or otherwise, because no one is required to accept it for payment. Now that's changed, right? Now El Salvador says they're going to take it for tax payments. Merchants have to accept it. It's become legal tender in El Salvador. Is this a big deal?
You know what? I mean, it's easy to dismiss it. It's only El Salvador, whatever, right? But it is really important. When I was a couple of years back, when cryptocurrencies were new, a lot of people were skeptics. I was amongst them. And one of the things that I said was, look, we've never seen any country willingly give up its ability to be the only publisher of legal tender in its borders, right? These things don't happen because the authorities say that they will. Now this is different. This is the first time that we've really seen somebody say, okay, well, we're gonna make this legal tender. So does that mean it's going to be the case in the US? Probably not. But it is a game changer for cryptocurrencies. It shows that there are those who are willing to accept it.
Eddie, thanks so much. Bloomberg MLive's Eddie Vanderwalt there on everything from cryptocurrencies to meme stocks. Now, coming up, Randy Krosner, professor at the University of Chicago Booth School and former Fed governor. We'll talk, of course, about the CPI print. That's coming up a little bit later. This is Bloomberg.
Okay, guys, as you can see, position opened on Bitcoin. This is short position. We sold short. So well done, all of you guys who placed an order and decided to follow our trades. Stay with me, and we'll go through this trade until the end, and we will collect the profit. Okay? If you want to get the strategy, if you want to trade other pairs or stocks or indices, you need to go to companyeye.co.uk and you need to get the strategy. Okay, guys, I'll speak to you later and stay safe.
New Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
The curtain will rise again. Broadway's returning June.
Have you bought tickets?
He's busted out.
You've got more time here.
Commodities are up.
Keep going.
To the moon.
No. Beautiful.
Bloomberg Surveillance, weekday mornings on Bloomberg Television and Radio.
In terms of what matters to bonds, I think that it's the Fed effect on yields that matters, and the Fed is saying they have an average inflation target, and it seems that the market might be listening, which to me means when you get a 4 or 5% handle on the CPI, it's largely expected and factored in. The people are slowly coming round to the idea that the Fed might be right, and that's despite the stampede of people who are coming on your show and elsewhere talking up inflation.
Stephen Major, their HSBC Global Head of Fixed Income Research, talking inflation earlier on Bloomberg, probably talking also about Mr. Trichet and others saying that they were worried about inflation, especially taking hold in the U.S. I think they used the word overheating. Well, joining us now is Randall Krosner. He's the University of Chicago Booth School of Business professor and former Fed governor. Randy, always great to speak to you, especially on such an important day for CPI reading. If you look at the markets, they're not really believing the Fed and how they're guiding them. So who's right?
That is the $7 trillion question, because it's the Fed's balance sheet. The Fed keeps saying that it's transitory, and at least in the short run, it is. You can say last month it was due to high used car prices. I'm sure there'll be some particular factor that could be pointed to for this month and for the next few months. But we're going to see some very high inflation prints. And the real question is not just whether the inflation itself is persistent, but do people believe that it's going to be persistent? Could inflation expectations become unanchored? That's really the challenging question. And that's the one that that's a lot based on sort of behavioral economics, behavioral science, psychology, rather than traditional economic modeling.
But if you look at the economic model, I mean, we had a print of inflation 9% higher in China. Is that under control, or could we be importing it from the Far East?
Well, I think part of that was because you saw a lot of increases in input prices. I mean, we're seeing commodity prices really take off. We're seeing shipping costs take off. And so input prices are going up. Undoubtedly, that will mean higher output prices. But again, the question is this just sort of a transition from an extremely low base from a year ago when things looked super bleak to now adjusting to something looking super strong? So it's a one-time change. That is, it's transitional. Or is it something that's going to be persistent? And that really comes down to expectations of whether wages keep going up, whether other prices keep going up, whether people expect prices to keep going up.
You know, the inflation that we're seeing now is higher than inflation that we've seen in the past decade. But over the past few decades, prices have continued to go higher and wages have stagnated for the American worker. Is that going to change now?
Well, that's, again, it gets to this question of what will wage demands be relative to what employers are willing to give. And certainly all of the stories, whether they're in the US, UK, or continental Europe, is that, well, and particularly in the US and UK, we're seeing labor shortages, that it's difficult to hire people. And so firms are offering bonuses, offering special schemes, and offering higher wages. So I think we're going to see a significant move up in in real wages, as we've already started to see already in the US. And again, the question is this a 6-month thing just through the end of the year, or is this something that's going to persist into 22?
The University of Chicago School of Economics has to be the epitome of American economic thought, led by Milton Friedman and George Stigler, and now people like you, Professor Krosner. How does Chicago economics view the current fiscal activity? What is the new classical macroeconomic view of all of this fiscal stimulus?
Well, certainly I wouldn't want to speak for my colleagues because, as you well know, at University of Chicago, our tradition is everyone has their own view, and so I'll give you my view, which I think we're doing an enormous amount of spending. If you look at what happened a year ago in the response to the pandemic, which I think everyone would agree was a sensible, immediate response, most countries spent somewhere between 10 and 20% of GDP. But then we spent $1 trillion last December, $2 trillion in the rescue package that was already passed. And there's another roughly $4 trillion on the table. That's 50% of GDP in a year and a half. I think it's very difficult to spend that much responsibly. You can only spend it responsibly if it's going to have a good payoff in terms of solving real problems, inequality or climate issues, or having a lot of productivity payoff. And I don't think we can do that so quickly.
And of course, this is an unprecedented amount of spending, Randy, just like we've seen unprecedented monetary policy throughout this pandemic crisis. We talk so much about normalization here on Bloomberg Television, but can we ever actually go back to normal?
Well, I think trying to go back to the past, that's not the normal going forward. So I think going back to normal isn't the right way to think about it, but can we have something that's more sort of stable, normal going forward? And I think eventually we can get there. Now, obviously, we were on a path to getting there before the pandemic hit. U.S. had raised interest rates, in the realm of around 2% or so, even though inflation had not gotten to its 2% target. We had near record low unemployment. So the U.S. was on a good trajectory. Then, of course, the shock hit. Shocks are always going to come. So it's always hard to get to kind of that long run steady state. But I think we would eventually move, not in the next year, but over the next few years, to interest rates closer to where we were before the pandemic, and hopefully unemployment rates that are around that same level.
Speaking of things that are evolving and changing, cryptocurrencies also have become more and more at the forefront of thought, and central banks now have to consider them as well. What is your take on digital currencies and a potential digital dollar down the road?
I think the digital dollar is quite a long ways off, but it really is very interesting to see countries like China doing very large-scale experiments with central bank digital currencies. And what's also somewhat ironic is that a lot of the impetus for the origins of Bitcoin and other digital currencies was a lack of faith in central banks. That after the global financial crisis, central banks were buying a lot of assets. We'd have this hyperinflation, and so we needed a private sector alternative to avoid debasement of the currency. Obviously, we've not had a lot of inflation. Maybe we will have that going forward. That's not my modal forecast, but it's possible. But it was to the whole impetus was to decentralize and get away from central banks. But central bank can adopt the blockchain type of technology, and rather than have it distributed and decentralized, can totally centralize it. And that's obviously what China is going to do. And so there's going to be a real battle on the centralization versus decentralization of the technology.
Randy, are we going to see much more regulation actually on some of these cryptocurrencies, or is it just, has that boat now left?
So it's very, very interesting. When I was at the Fed through 2009, that's when Bitcoin had first started. And there's a debate in the Treasury, at the Fed and elsewhere about, what do these currencies mean? Are they just used by evildoers, bad guys, or can they be used for good purpose? And so I think that debate still rages. And so I think that the train has left the station, that we will have some forms of digital currency with us, whether they're primarily given by the central banks or in the private sector. But I do think that undoubtedly with volatility and challenges in these markets, you're going to see some forms of regulation come in. And certainly some, like Coinbase, welcome that because they'd like to see more regularization of the market.
Randy, thanks so much. Randy Krosner, there, University of Chicago Booth School of Business professor and former Fed governor. What a great day to speak to you. Now, coming up in the next hour, Peter Hooper. He's Deutsche Bank Securities Global Head of Economic Research. Of course, we'll ask him about some of the new SEC rules that could affect U.S. stocks. We'll talk to him about inflation. This is Bloomberg.
Surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance Early Edition. I'm Francine Lachman in London, Matt Miller in Berlin, Kaylee Lyons in New York. Now, we're also joined by Tom Keene, co-anchor of Bloomberg Surveillance, who's so excited about the inflation report coming up later that could actually move markets, and you have a great guest on it.
We got a really important guest on it with David Folkerts landed on Jim Reed, Peter Hooper of Deutsche Bank. It's an early lead for the essay of the summer, Francine. It's on inflation, hugely controversial. It's made a very nice splash in New York. Dr. Hooper will join us here on their fears of the time bomb of inflation. They're not predicting that, but they're framing out how that could happen. That's a very strong day with us. Also looking forward to speaking to Jeff Yu, who will join us from BNY Mellon. The chart, Francine, is something to give you joy. It really is the ultimate Johnson victory chart. I'm going to call it the triumph of Boris. Trade-weighted sterling back 40 years or so, the John Major collapse, up we go with a miracle of Britain, and then down, 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 Brexit in the blue circle, and then we cratered. And would we do another John Major? And the answer is, ever so slightly, trade-weighted sterling is doing better.
Yeah, it is doing better. He's just distracted right now on his 100th fight with the EU over the Northern Irish Protocol. So it'll be interesting also how U.S. President Joe Biden actually navigates that, Tom.
Well, we're going to cover that. Of course, you know Guy is in Cornwall, as well as our Jennifer Jacobs. I just went back and forth with her. And Josh Wingrove will join us from the White House as well.
Yeah, Tom Keene, I'm looking forward to the program, co-anchor there of Bloomberg Surveillance, that will begin straight after Early Edition. Now, this is a look at what else we're watching. Kelly, CPI moving the markets.
Yep, just over 2.5 hours to go until that crucial consumer price inflation data, Francine. Of course, we're looking for a gain of about 0.5% on a month-on-month basis, which would bring the year-on-year gain to 4.7%. That's on the headline. For core, when you back out food and energy, looking again at 0.5% month-on-month. Of course, as we know, energy had a major impact in April's data as well, so that impact of higher commodity prices, definitely something to watch out for again, Matt.
You know, I'm looking on Google Maps for the original store number 1 at Brooks Brothers. Used to be on 44th and Madison Avenue. It was one of my favorite places to go. On the 5th floor, you could go up there, get a glass of bourbon, shoot some billiards with Tom the Tailor, but I don't know if it exists anymore. I'm not seeing it on Google Maps, and it's breaking my heart a little bit. You know, they've decided to move into athleisure, which I can't imagine saying Brooks Brothers and athleisure in the same sentence, but I guess we're gonna have to do it now.
So, Matt, I know you're really upset about this. I find the story absolutely fascinating because it just, you know, I don't know whether it's athleisure all the way for everyone, but if you do formal wear, you have to do it right, and you have to make sure that you're making money at it. Otherwise, maybe you change tack.
Well, they invented, I mean, this is the American traditional suit maker. Now this is their new, Henry the Sheep is their new mascot. Previously, it was the Golden Fleece. I've got this tie as bespotted with
Matt,
golden fleece, albeit in red.
Maybe formal wear is more European vavavoom. I'm watching the ECB decision. It's at 7:45 a.m. New York time. Of course, the focus will be on what they do with the higher pace of emergency asset purchases, and it could move euro. Up next, more Bloomberg Surveillance. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Europe's financial sector has made some progress with minority and female inclusion, but any momentum has slowed in the wake of COVID-19. I'm Francine Lacqua, and we'll take a look at the pandemic's unequal impact on financial services. We'll delve into the data and some of the reasons behind the drastic drop of women in the workforce. We'll also get the views of two very senior women in the industry on creating an inclusive environment, retaining talent, and the future of work. All in our latest Money and Equality special this weekend on Bloomberg Television.
market is becoming more concentrated and less contestable.
Right now, people are focusing on low-quality stocks, whether they're meme or not.
We actually think the markets tread water for a bit as we continue to be concerned about inflation and taper talk.
We have a real recovery in process. I don't think the roaring 20s are the right analogy.
Well, I think inflation is going to run. That's a good sign. That is a economy getting back on track.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. A simulcast on radio, on television. An exceptional day for news flow. An ECB meeting. Matt Miller will have a lot on that. Sitting in for John Farrow today. All the events going on in Cornwall. Our Guy Johnson there with Jennifer Jacobs and Josh Wingrove. And Lisa and I really don't care because we're just looking at the markets, which has a life of their own, and that with the inflation numbers today. Lisa, let's get away from the international relations just for a second and frame out the curiosity of inflation in America.
The expectation is for yet another landmark figure, the CPI figures, which are going to come out at 8:30 a.m. The idea here, we're going to see the pace rise to the fastest inflation print since 2008. We see this again and again. Even in Japan, we saw the fastest inflation when it came to producer prices since 2008. People shrugging it off. They continue to see the Fed as being correct and that it's transitory, Tom. I am wondering what will change that.
You wonder what will change. It's transitory. We'll see the data. Michael McKee will help us out with that. Before that, Michael McKee will help us out with an ECB meeting. Matt, don't tell me it's a snooze fest.
No, I don't think it is at all, Tom. In fact, I think it's interesting that the ECB is targeting inflation close to but less than 2%, whereas the U.S. is looking to overshoot. And I want to see if they get on the same page. That could happen today.
Well, we will see. Right now, there's a brewing storm. I do want to dive into this, and we'll go to Guy Johnson on this in a moment. The Times of London, folks, a number of hours ago said that there was a formal statement by the U.S. State Department, a so-called démarche, where we basically chastise the United Kingdom over EU and Irish policy. Our Jennifer Jacobs has made very clear in her reporting that is not the case. We'll have much more on this through the morning. Matt, this is a hugely sensitive issue for Brussels, for London, and for Dublin.
Yeah, absolutely. But as Guy Johnson was saying earlier, Joe Biden is there to make friends. He wants to try and heal the divisions created by Trump. And if you go there and immediately say, you know, bad boy, Boris Johnson, you can't do that, it doesn't really start the conversation off in the right tone.
Well, the last 9 hours or so have been really extraordinary for those waking up in America. Let me do the data right now. Lisa will have a really interesting Thursday brief, including claims data today as well. Futures, well, the NASDAQ off the bloom with S&P up 3, the VIX churning here 17.76, and that really describes the rest of what I see. The 10-year yield under 1.50 after that extraordinary move today. JP Morgan, I know among others, saying a massive short cover on the bet of higher prices, lower prices and higher yields. That bet hasn't worked out, and we've been going the other way with what's called convexity or acceleration. We accelerate under 1.50%. Brent crude $72.38. You'd think that'd be a big topic in Cornwall. I think it's barely on the radar. And dollar, I mean, churning as well. Lisa, what are you going to do, like a 1-hour brief today?
Honestly, today is going to be incredible, and I could have so many items. I really want to focus, though, on the CPI print. We've been basically counting down to this all week. 7:45 a.m., as we were talking about, we do get that ECB rate decision. The expectation is for some guidance on the monthly purchases of bonds. Basically, people are not expecting a big change. $80 billion has been the figure, 80 billion euros rather. They expect that to continue. 8:30 a.m., we're also going to get that press conference from Christine Lagarde. 8:30 a.m., the CPI, as well as initial jobless claims. My question is, what will move the needle? Right now, as you were saying, Tom, there has been this incredible capitulation with respect to the short bets on interest rates moving higher and the price moving lower. All of a sudden, people coming out and saying, forget it, we cannot bet against treasuries. They continue to rally. We saw that incredibly strong rally, debt sale of 10-year notes yesterday.
Yeah.
What's going to change that? Is it going to be one print? This is a faith-based bet whether inflation is going to rise or it's not. Peter Hooper of Deutsche Bank coming up, and he's going to talk about why there is a structural shift, the biggest change in 40 years to the inflation paradigm, Tom. And that is a question of why this is not being reflected in prices, especially if the near-term data points seem to confirm an inflationary rise. Tom?
Well, we'll see if it comes along. But, Lisa, let's continue on this and begin to frame Dr. Hooper's important note with David Folkerts Landau.
We'll get there in 1 second.
Oh, you're not done.
2 p.m., Treasury Secretary Janet Yellen is going to present her budget
spa.
to a House Appropriations Committee. I'm interested to hear what she has to say about the CPI print and about this seismic shift. You can get to it right now, Tom, in the inflation.
Well, the seismic shift, she's doing this. The real shift is she's doing her testimony in the middle of the surveillance nap, which is just, that's just uncalled for.
Please send a telegram to the White House. They will deal.
As you know, Lisa and Matt, there come along research every once in a while that just makes you stop, and Deutsche Bank has done that with a fare thee well. And Lisa, what were your thoughts on what you saw from David Folkerts Landau, Jim Reed, and coming up here in a bit, Peter Hooper?
Well, this is the issue to me, Tom, and I think that they articulated it brilliantly, the idea that never before have we ever seen both the fiscal push in tandem with the monetary push, a lack of constraint with respect to debt sustainability, a lack of constraint with respect to money supply. These are not issues anymore for policymakers because we have not seen them create inflationary conditions for the past couple of decades. All of a sudden, that is a shift in mentality, and at what point will this actually lead to higher inflation? And many people believe this time is different just because of that, Tom. And the interesting thing is you're not seeing that reflected in prices.
And I must admit it's Germanic. I mean, you look at Peter Hooper's work at IMF and Jim Reed in the trenches in London looking at the market tick every day. But Matt Miller, this is about David Folkerts Landau, his work with Peter Garber and Dooley over the years. The money line, Matt Miller, to me, which really has to make Madame Lagarde sit up straight, neglecting inflation leaves global economies sitting on a time bomb. Does that underpin what we see at the ECB today?
I don't think so, and I think that's why he wrote that. You know, there's been a lot of commentary that sounds fairly similar coming out over the last few days. So more and more people are sitting up and taking notice. Inflation could become a real problem, especially with this big fiscal push in tandem with monetary, and all of a sudden maybe something the ECB has to start thinking about.
In this horrifically busy news day, what we're going to do is go to Peter Hooper here in a bit. But right now, our Guy Johnson in Cornwall this morning. Guy, what is your agenda in the coming hours? What should we look for in the American morning and into afternoon?
Tom, 10:30 Eastern, we're going to be seeing a meeting between Joe Biden, the President of the United States, and the Prime Minister of the UK, Boris Johnson. The scene setter for this event. It basically cues up everything else. The other leaders are going to be arriving a little bit later on. The main event obviously taking place tomorrow. But I think this event between the Prime Minister and the President, I think hugely interesting and hugely symbolic as well. A number of different things are going to come out of that. Clearly, there is an effort underway here to try and vaccinate the vast bulk of the world by the end of next year. That fulfills a number of different criteria for particularly President Biden. He wants to sort of have the humanitarian aspect to the G7. He wants to push back at China as well, Tom. He wants China not to be able to fulfill that role of vaccinating the world. He wants the democracies. He wants China not be able to do that. And then there's the climate aspect to that as well. He basically, and Boris Johnson has the COP summit coming up in November. We find ourselves in a situation where a lot of poorer countries are saying, we're not going to sign up to your climate pledges if you don't help us vaccinate. So at least it solves that problem as well, Tom.
Guy, just to the tensions of a few weeks ago, you are our airline expert. You have a very important interview for all of our listeners and viewers coming up on transatlantic flight. Guy Johnson, the last time I talked to you was over the crisis in Minsk in Belarus as well. Explain this meeting with the backdrop of what we saw with Belarus in the June 16th meeting of the president with Mr. Putin.
Well, I think there is the president wants to build the G7 into a club of democracies that pushes back against autocracies. He wants to push back against Russia. We have that meeting coming up with Vladimir Putin that is going to be taking place in Switzerland. He also wants to push back against China. Despite what we heard yesterday on the trade front, there is a definite concerted effort to kind of rally democracies onto a united front so that they can push back against China. That is going to be interesting to see exactly how that develops with the Europeans, who have their own ideas on that front. There is a clear narrative coming out of the White House on that front. Then when you come to reopening of the North Atlantic, Tom, I think you're going to hear a lot of fine words here. You're going to hear about a sort of commission basically being set up to try and reopen the North Atlantic, a working group. You're going to get the same offer made to the EU when there is the EU-US summit next week as well in Brussels. But I don't think you're going to get the details. And I'm going to be talking to the IAG CEO, the owner of British Airways, in around 20 minutes' time. I want to get his sense of whether or not that's enough for him. What details does he expect to hear from this meeting? I suspect he's not going to get much, Tom.
When you talk about, Guy, reopening the transatlantic corridor and the decision on vaccinations between all the nations to get the world back up and running, there's a question about the hard feelings ongoing on Angela Merkel's part for the fact that the U.S. did not distribute more of its vaccine earlier, as well as some of the frayed relations under the President Trump era. What is your sign that she's perhaps softening or that the relations are materially changing between Germany and the U.S.?
Well, I think Angela Merkel is going to be delighted that she's not having to deal with President Trump anymore. I think that is the first thing that we need to take away from this. She is outgoing. That's the second thing we need to take away as well. This is her last meeting, but she still wants to be a force here at this meeting. You've got Emmanuel Macron, you've got Angela Merkel, and you've got Mario Draghi as well. They want to kind of coalesce that power base and try and use it to represent an EU agenda. But there is frustration, and there was huge frustration when the White House announced the patent waiver. The Europeans felt that they weren't consulted on that. They felt as well that the Europeans have been delivering vaccines around the world. They want to make sure that their voice is heard in this, that it is clear that this is not just a US push, this is a G7 push, and that the Europeans are at the vanguard of that, Lisa.
Is the UK the most frustrating country in the G7, Guy Johnson? Because not only have you got them going back on their word when it comes to the Northern Ireland Agreement, but they're also trying to now exempt the City of London from a global minimum tax, which, by the way, the City of London has a bigger GDP than all of the Republic of Ireland. So it's not, you know, small potatoes. This is a big deal. And if everyone starts to pick, you know, their most important economic areas for exemptions, what's the point?
Absolutely, I think that is certainly true, Matt, and I think it is peculiar. I think that the G7 London meeting produced this deal, and instantly it's the UK that wants to be pushing back on it. So I think it's going to be interesting to see how the UK manages that messaging. I think we are going to get Rishi Sunak here, so it's going to be interesting to see how that develops. On the issue of Northern Ireland, clearly the president leans very heavily on his Irish heritage. I think there is frustration that the Brexit process has delivered a risk to the Good Friday Agreement, and I think President Biden is going to want to make clear that he is very much against that. He does not want to see anything that undermines the Good Friday Agreement. Ultimately, the US is the guarantor of that agreement. Nevertheless, I think the conversations that were had in the British press this morning about some sort of official rebuke, that's being walked back quite quickly. The president has come here to try and re-establish relations. Undermining it that way, I don't think is on the agenda.
I want to make clear, folks, that Bloomberg Reporting is a walk back right now on the demarche. Guy Johnson, thank you so much. With Josh Wingrove and with Jennifer Jacobs in Cornwall today, and we'll continue with our reporting of the president's trip, his first trip abroad. Coming up as well, Guy Johnson in conversation with a gentleman of British Airways. It's a fancy title. Forget about it. It's the gentleman of British Airways, of course, on transatlantic pandemic recovery. Right now, there can be always a moment that comes along where you say, it's the essay of the summer. Boy, it's awful early to say it's the essay this summer, but David Fokerts-Landau and his team at Deutsche Bank, with the leadership of Peter Hooper, their global head of economic research, have generated 18 thought-provoking, must-read pages for Global Wall Street. We're honored that Dr. Hooper could join us this morning. Peter, you say it is the end of neoliberalism. We have a risk of going back to Reagan-Volcker. How close are we to going back to a time of shockingly high inflation?
Tom, we've obviously seen a huge shift in both monetary and fiscal policy that's given us a lot more stimulus to the economy than anyone would have imagined a couple of years ago. The chances of getting back to the high inflation 60s and 70s have taken a leap forward. It's still not the most likely outcome, but certainly the risks have risen tremendously, thanks to 25% of GDP in fiscal stimulus in the last year and a half. Who would have imagined seeing something like that?
Peter, this increasingly becomes a game of faith because people are dismissing current data as simply transitory. How do you convince clients who say, look, it has been this way for 20, 30 years where we've seen inflation come down progressively in a steady fashion if you look over time? What do you say to them to convince them that this time is different?
And Lisa, you're right. The market is remarkably calm about in the face of this storm coming. I think you have to live through a surge in inflation that's going to be reversed for a while. And then you have to look ahead to the possibility of an economy that's going to be operating at well above potential. I mean, yes, we've been expecting, we had a big surprise in April. People have revised their expectations, and now the numbers we're likely to get for May not looking anywhere near as scary. And there are reasons to expect things to slow down near term. But if we get this increase in household saving in excess of 10% of GDP that's been salted away here, not spent so far, if that begins to come on stream as households are normalizing their spending, as pent-up demand is being released, we're going to see this economy push well into overheated state. And the problem is that the Fed has told us they're going to be late in removing the punch bowl, if you will. I mean, they want to see the economy overheat before they start raising rates. There's going to be a recognition lag. And there's going to be a long response lag of the economy to Fed tightening. So the chances of things getting out of hand down the road certainly have increased.
Hold on a second, Peter. You're saying out of hand, and this is a distinction from other people who say that, yes, we may see above trend inflation, but we're not going to go back to the 1970s. Are you saying that we could go back to 1970s style inflation?
There's certainly a risk there. You know, our numbers say that there is a chance, in fact, an uncomfortably high chance that you see the output gap for the U.S., the amount by which GDP exceeds potential, moving up above 2-3%. The high we've seen for the last 3-4 decades has been around 2%, and inflation hasn't gotten out of control. In the 60s, it went up to 5.5-6%. We could be there if as much as a third of this savings that's been accumulated, unusually large savings been accumulated over the last year and a half, is spent out over the next year or two. Peter, that would be a massive push to GDP.
Peter, the Bank of England chief economist Andy Haldane writing in the Statesman yesterday saying this is the most dangerous moment for monetary policy since inflation targeting began in 1992. He's saying, you know, you can't look anywhere and find something whose price isn't rising. Is this overheating? Is this overheating intention shared in the UK and the ECB as much as it is in the US?
Well, I think so. Europe's in a different situation. Certainly, the labor market going in was not as tight as in the U.S. And we have not seen the kind of shift in fiscal and monetary policy regime that the U.S. has had. The ECB has not said they're going to be reactive as opposed to preemptive. If we saw inflation picture in Europe the way we are anticipating in the U.S., I think the ECB would respond quite differently. Well, we have had the NGEP, the recovery program, et cetera, spending in Europe coming up. That's not anywhere near as large as what the U.S. has on tap. So Yes, I think there is concern about near-term supply disruptions, and we are seeing some impressive increases in inflation in Germany. But the sense that the risk is anywhere near as large in Europe is just not there.
Dr. Hooper, underpinning this, and I say this with great respect to Steve Roach, you know him from Morgan Stanley and now Yale University years ago, is the underpinning of your work at the IMF and also the work of Dooley, Folkerts, Landau, Garber, which is always watch the flows, watch the money. Many of you folks will know Martin Wolf and his wonderful work at the FT on this as well. If we get the time bomb in your 18-page report, what does it do to the flows of capital in the world?
Well, now the time bomb is another way of describing the Fed being late to the party. Okay, late in terms of taking the punch bowl away. Because we've gotten behind the curve, we're going to need to act aggressively. That means rates go up sharply. That's very disruptive to financial markets. It's very disruptive to many emerging market countries with huge amounts of debt that are going to be very sensitive to a sharp rise in U.S. rates. That's the concern down the road. It's a risk. It's not in my way of thinking the most likely scenario yet, but it's certainly something we need to have our antennae tuned into.
Your x-axis in this report, to be clear, folks, is not getting out to Q3 or Q4 and the rest of the game of market economics and the financial media. The Deutsche Bank view begins to frame out 2024. What is the efforts we can do before 2024 to ameliorate the time bomb?
Well, I think the Fed has gotten into this inflation averaging framework.
Right.
This was exactly what they needed to do to deal with a world where they were struggling to get inflation up to 2% and get inflation expectations to a more desirable, sustainable level. Inflation expectations are back. I think the Fed is going to need to begin to recognize this risk, certainly over the next year, and begin to edge toward a sooner tightening than is currently priced in.
Peter, let's start it at Jackson Hole. I don't know if you're going to be there with David, but we'd be thrilled to speak to you. Our Michael McKee, I know, will be reporting there. Let's go to the time bomb of Jackson Hole. Is the time bomb of Jackson Hole for the markets, for our radio and TV listeners and viewers, is it a change back to the theories and regimes pre-pandemic? Can the Fed do that, leading the rest of the central banks?
I think the central focus at Jackson Hole will probably be, is the Fed going to give us a clear signal that they're beginning to talk about unwinding their balance sheet? We're still a ways away from the Fed recognizing seriously this risk, and I mean, they have a ways to go to get to that point.
And but, Peter, this is, a lot of people are looking for the talking about tapering, or talking about tapering as being the key moment for Jackson Hole. There's also a question, though, going to 2023, as you did, does the Fed have the tools to control inflation in the way that they have in the past? And that, I think, is sort of underpinning your call. Are you saying that the Fed does not have those same tools, given how much money has been pumped into the system?
The Fed certainly has the tools to deal with inflation. It doesn't have the tools to deal with it in a soft landing sense, if you will. It's very difficult if you're going to be behind the curve to deal with an inflation problem that's building some momentum, that's getting into expectations and moving beyond desired levels without being very disruptive. The Fed has never been able to deal with a rising inflation problem, bring it back without causing a recession. And if they're behind the curve when they start this process, it could be a major recession.
Dr. Hooper, thank you so much for this first conversation on this important research. We're thrilled that Peter Hooper of Deutsche Bank could join us today. We protect the copyright of all of our guests. Please get this important report from Deutsche Bank. Matt Miller, I was going back and forth with Dr. O'Leary, and he loves that you brought up Mr. Haldane's terse essay here. Give us more on that, Matt Miller. What did Mr. Haldane say about this moment of worry on inflation?
Yeah, well, he was writing in the New Statesman yesterday, and I thought it was interesting because, of course, he is the outgoing chief economist at the Bank of England. And when you're leaving, when you're going out the exit door, you're more likely to be very honest about what you think. He said it's a very dangerous moment and that central banks risk making a bad mistake if they don't act quickly to quell inflation. Obviously, the problem is waiting longer. His take is at least waiting longer would require larger and faster interest rate hikes than anyone expects. And you've heard this from others as well. That could result in a full-blown recession, as Bill Dudley told you just a couple of days ago.
Well, Mr. Dudley on fire with those columns for Bloomberg Opinion. Lisa Bramah, let's try to bring it back to what we observe, which is price, and in the market, price is indicated by yield. I believe we have a massively negative real yield. That's the elephant in the room for Jerome Powell.
The idea here that everyone is expecting Jerome Powell to keep the pedal to the metal with respect to the $120 billion of bond purchases every month, keep the easy money policies for longer, suppressing bond yields far below where inflation is. I will say, you mentioned Mohamed El-Arian, and he also wrote in a column in the Financial Times about how dramatic the risk-taking is and what some sort of potential faster than expected hike down the line could do to that.
Thank you so much to Lee Brody and our team for that, to getting Dr. Hooper on. I can't say enough. For those of you not on Global Wall Street, this paper has created a sensation among people worried about the linkage of economics, finance, and investment. The ECB later, our Guy Johnson in Cornwall. Please stay with us. This is Bloomberg. Good morning.
Bloomberg has enhanced search on the terminal. to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg Surveillance, and we say good morning to you. It is a solar eclipse, but a different solar eclipse. You know, it is the geometry of the sun, the moon, and the earth, and so much of it depends on where the moon is around the earth. To cut to the chase, this is an annular eclipse where it will not be completely blocked. The sun will not be completely blocked. You'll see a little bit of eclipse in Charleston, South Carolina, but far to the north, beginning on the shores of Lake Superior to the north, and then over across Greenland, the Arctic Circle, and into Asia, you will see almost a partial eclipse. To be clear, this is the most dangerous for eye damage.
Yeah.
So be very careful for those out there watching this. It's not a normal partial eclipse. There will not be that moment, Lisa Abramowitz, where you can take the glasses off and look at the majesty of this moment.
Yeah, although even then, I remember when there was a full solar eclipse, do you remember wearing those glasses and seeing the shadows and all of the crescent shapes? It was really quite remarkable. If you take a look at markets, I find this fascinating, Tom. We're continuing to see, you know, a bit of an easing in the bid into 10-year Treasury yields, but still incredibly low, ahead of what's expected to be the highest CPI since 2008.
We again welcome all of you. The news flow, absolutely extraordinary, whether the G7 meetings in Cornwall, what we're seeing in economics, and of course an ECB meeting coming up as well. We pause for one of the greater concerns of our listeners, our viewers, and that is the travel of our airplanes internationally. Our expert on this, doing double duty in Cornwall today, is Guy Johnson with a gentleman from British Air. Guy?
Tom, thank you very much indeed. Yes, while we get ready for the G7 to take place here in Cornwall, we've also got the A4E conference taking place. This is a gathering of airline CEOs. The AGM is taking place today, but a lot of focus will be on what comes out of Cornwall, what comes out of the meeting between Boris Johnson and Joe Biden later on this afternoon. An expectation that a working group will be set up to try and work towards reopening the North Atlantic routes, critical airline routes that are so profitable for the airlines that fly them. One of those that is IAG, owner of British Airways, owner of Iberia, owner of Aer Lingus, and a whole load of other airlines. It is now run by Luis Gallego. He is the CEO of IAG and joins me now from Heathrow. Mr. Gallego, thank you very much indeed for your time today. As I say, a working group set to be announced later on this afternoon by Boris Johnson and the President of the United States, Joe Biden, but not many details are expected to come out. What is your reaction to that? What do you want to see coming from these two gentlemen?
Good morning. I think we have a good opportunity to take decisive actions and to open the corridor in the North Atlantic. It's an important market for us, but it's also an important market for the world. We need to open a corridor between two countries where they have a successful vaccination rate. I think we need to take into consideration that every day that we are not flying, UK businesses are losing around 23 million pounds. So it doesn't make any sense not to take decisions based in scientific data and risk, to take a risk-based approach.
In terms of your planning, when do you think that is going to happen? When do you think we are going to see some progress being made?
We consider that right now the situation that we have between both countries allow to travel. I think vaccinated people, they can travel freely. We don't see why do we have to have restrictions between US and UK. So as soon as we can have an action and to open that corridor will be very important for all of us. What we are asking to the G7 leaders is that we want to open corridors between countries where successful vaccination rate. We also need affordable and simple testing. It's important also to have well-staffed borders where we can use contactless technologies. And for sure, digital passes are going to help in all this because we need to check